Very good day friends. In this video, we will pick up the topic of profits and gains of business or profession and we will see how to compute income under the head PGBP. And we will look at various themes. We will look at the basic concepts, incomes taxable under the head PGBP, deductions, general principles in respect thereof. Then we will look at various deductions. For example, deductions for assets, amortization, expenditure for special purposes, interest, employee welfare, taxes, special deductions, general deduction under section 37(1). Then we will look at the disallowances, that is expenses not deductible in certain circumstances. We will look at special provisions, compliance provisions, and finally presumptive income provisions for small enterprises. The timestamp for all these themes is given in the description box, which you can see and use. Now let's begin with the basic concepts. So business income under the Act is the income computed under the head PGBP, and that is computed as per the provisions of the Act. So it is not the same as the net profit of a concern as per its profit and loss account. So there are two basic approaches that one can follow for computing income under this head. One is to directly compute such income as per the provisions of the Act. So just add up the various items of income which are taxable under this head, then allow various deductions as per the provisions of the Act, and the result is the income taxable under the head PGBP. But this is not how generally the questions are asked in the exams. In the question, mostly you will find the profit and loss account, and you will be given some further information, and then you will be asked to compute income under this head. So in that particular case, we take the net profit as per the P&L account as the starting point and then make adjustments to arrive at the income taxable under this head. So we pick up the net profit as per P&L account, and this is the starting point, and then we make adjustments to incomes and then adjustment to the expenses. Now adjustment to incomes can be of three types. Firstly, we add incomes which are taxable but which are not credited to P&L account. Okay, we will look at section 28, and there are several items of income which are listed there which are taxable. So if these are not credited to P&L account, we need to add them. Then there may be income which are credited to P&L account, but either they are not taxable, say because they are exempt under section 10 or any other provision, or they are taxable not under the head PGBP but under any other head of income. In that case, we need to exclude such income. So we reduce the amount of such income. Then there are certain deemed profits, and section 41 is the relevant section. We will look at that. So these are the adjustments which we need to make to the income. Now adjustment to expenses fall under two categories basically. Firstly, we need to add expenses which have been debited to P&L account but are disallowed. Okay, so certain expenses are not allowed as a deduction and we call that disallowance. They are provided under sections 40, 40A, 43B. So if such expenses are debited to P&L account, then we add them back. There could be certain expenses which are allowed as a deduction but which are not debited to P&L account, right? And sections 30 to 37 deal with the various types of expenses and allowances which are allowable in computing PGBP income. So if such expenses are not debited to P&L account but they are supposed to be allowed as a deduction, then we allow deduction in respect of those expenses. So we reduce such expenses. After these adjustments, we get what we call as the income taxable under the head PGBP. Now, basically what is charged under the head PGBP, and this comes from section 28. So what is charged is the profits and gains of what? Of any business or profession, which is carried on by whom? By the SSE. When? At any time during the previous year, right? So if the SSE carries on any business or profession at any time during the previous year, then profits and gains of that business or profession are chargeable to tax under the head PGBP. We have noted in the first video on basic concepts that income under the head PGBP is computed in accordance with either the cash or mercantile system of accounting which is regularly employed by the SSE, right? So if the SSE employs cash system of accounting, then the income is taxable on receipt basis and expenditure is deductible on payment basis. If the SSE follows mercantile system of accounting, then due basis is involved. Now, scope of taxation is something that we have discussed in the video on residential status and scope of total income. To quickly recap, if business income is Indian income, then it is taxable in the hands of all persons irrespective of the residential status. If the business income is foreign income, then it is taxable in the hands of a ROR on global taxation basis. So business income is Indian income when it accrues or arises in India, or is deemed to accrue or arise in India, or is received in India, right? It is taxable in the hands of all the persons. If that is not the case, then it is still taxable for a ROR on global taxation basis, but not in the hands of a RNOR or non-resident. But there is one exception. Even if the business income is foreign income, it is taxable in the hands of a RNOR if it is derived from a business which is controlled in or a profession which is set up in India, right? In that case, business income is taxable in the hands of RNOR even if it is not Indian income. Now, we also noted in that video when is the business income deemed to accrue or arise in India, in which cases income from a business connection in India or from royalty or FTS. So royalty or FTS is in the nature of business income, but there are special source rules. If the conditions of those source rules are satisfied, then royalty or FTS is also deemed to accrue or arise in India. And when the income is deemed to accrue or arise in India, it is taxable in the hands of all persons irrespective of their residential status. We noted in the video on house property that income from house property which is occupied by the SSE for his business or profession is not taxable under the head income from house property, but it is covered under the head PGBP. Now coming to section 28, section 28 lists the incomes which are taxable under the head PGBP. And certain items of income which are taxable under the head PGBP by virtue of section 28 are listed in this table. So we will quickly go through this list. 28I, it says that profits and gains of any business or profession which is carried on by the SSE at any time during the previous year is taxable under the head PGBP. Second is compensation. So compensation is generally a capital receipt. And we have noted in the video on basic concepts that capital receipt is not taxable by default unless it is specifically taxable. So by virtue of section 28(2)(i), what is taxable? Compensation if it is received for termination or modification of terms and conditions of an agency or a business contract or an office of management of a company, right? So for example, if there is an agency, it is terminated and compensation is received, it is taxable under the head PGBP. Similarly, the government may sometimes take over a business, right? And there may be a statutory vesting of management of any property or the business. And the SSE may receive compensation on that account. That compensation is also taxable under section 28(2)(i) as PGBP. Third is income of associations. For example, a club, right? So we know the principle of mutuality. Mutuality, a person cannot earn income from himself, and therefore if the members make contributions to a club, those contributions are not taxable, right? Because a person cannot earn from himself. But there is an exception. There may be income of an association, which may be a trade association or a professional association or a similar association. From what? From specific services performed for its members. So that means these services are not available generally to the members, but to the specific members on a charge, right? Now, principle of mutuality doesn't apply in such case, and therefore such income is taxable under the head 28(3)(i) as PGBP income. Next, export incentives are taxable. So profits on sale of import license, cash assistance against exports, duty drawback against exports, profit on transfer of DEPB and transfer of DFRC, all of these are taxable under section 28. Benefit or perquisite, this is taxable under section 28IV or 28(4). Now, sometimes an assessee may receive any benefit or perquisite which arises from business or the exercise of a profession. It is taxable under the head PGBP. Whether it is convertible into money or not, it doesn't matter. Whether it is contractual or gratuitous, it doesn't matter. So long as it is a value in the nature of benefit or perquisite, which has got a direct connection, which arises from business or the exercise of a profession, it is taxable as PGBP. So if Ram is a chartered accountant and he is gifted a car worth rupees 5 lakh by his client in view of his exceptional services, then rupees 5 lakh is taxable in the hands of Ram as income under the head PGBP because it is a benefit or perquisite arising from the exercise of his profession of a chartered accountant. Now section 28VA covers non-compete fees. Non-compete fees is what? Fees received for not competing, right? So any sum received, and it can be in cash or kind, it doesn't matter, under an agreement. So there is an agreement under which the assessee is not supposed to carry out any activity in relation to any business or profession, right? And a sum is received, that sum is taxable as PGBP income. It is called non-compete fees. So I receive, for example, a sum of rupees 50 lakh from my competitor because I agreed not to carry on the competing business for a period of say 5 years. So that is non-compete fees and it is taxable under the head PGBP. Similarly, I may receive say 50 lakh rupees for agreeing not to share any know-how, patent, copyright, trademark, license, franchise or any similar right or information or technique. As against that, I may receive a fees that is called non-compete fees and it is also taxable under the head PGBP. Finally, we have section 28(6)(28)VI, which deals with key man insurance policy. We have noted in the video on exempt incomes that insurance policy proceeds from an insurance policy including bonus is exempt under section 1010D. But we also saw there that sum received under a key man insurance policy is not exempt, it is taxable. So if it is arising on account of a business or profession, it is taxable under the head PGBP by virtue of section 28(6). So now we will look at certain general principles pertaining to deductions. Now a deduction may be allowed either of an expenditure or a loss. So expenditure, as we know, is allowed as a deduction as provided under sections 30 to 37. So sections 30 to 37 are the sections. They contain provisions which lists down various kinds of business expenditure which can be allowed as a deduction in computing PGBP income. But that is allowed as a deduction unless it is disallowed. So certain business expenditure may be disallowed. That means they are not allowed as a deduction. So unless disallowed, the business expenditure can be allowed as a deduction in computing business income. What about a loss? Loss is not an expenditure. So loss which is capital in nature, it is not allowed as a deduction. But loss which is revenue in nature, it is allowed as a deduction if it is incurred in carrying on business or profession and which is incidental thereto. It is allowed unless it is specifically disallowed. So for example, stock in trade is destroyed by a fire. It is not an expenditure, it is a loss. It is not capital in nature, it is a revenue in nature, and it is incidental to the business or profession which is carried on by the assessee. And therefore such loss is also allowed as a deduction. Now in certain provisions, we will find the word paid. The word paid has been used. So ordinarily one would think that paid means that the amount has been actually paid. So that means when will the deduction be allowed in respect of expenditure? If the provision uses the word paid, then can we allow deduction if the expenditure has become due but it has not been actually paid, right? For example, we will look at section 30 after some time and we will see that it covers deduction on account of rent and it uses the word paid. So rent paid for premises is allowed as deduction. So regarding this particular question, the Act provides that the word paid doesn't mean only actual payment. It means paid or incurred according to the method of accounting on the basis of which the profits and gains are computed under the head PGBP. So even if the amount has not been actually paid, but the expenditure has been incurred, it has become due, liability has arisen, and the assessee is following mercantile system, then the deduction is supposed to be allowed. We have already noted the provisions of section 14A in the video on exempt income. So there may be certain incomes which are exempt, right? And certain expenditure may have been incurred in relation to that income. And section 14A says that such expenditure which is incurred in relation to exempt income is not deductible. Now there may be expenditure which may either be capital in nature or revenue in nature. There are three sections, section 30, 31 and 37.1. 30 and 31 we will just now shortly look at. It deals with the deduction on account of rent, rates, taxes, repairs and insurance on account of premises, machinery, plant or furniture. And 37.1 deals with the general deduction. These three provisions provide that capital expenditure under these sections is not allowed as a deduction. Barring these three sections, when we are talking of the deduction under other provisions, we really need not worry about the analysis of whether a particular expenditure is capital or revenue in nature, right? But when we are dealing with 30, 31 and 37.1, we need to keep in mind this distinction. So if it is a capital expenditure, it will not be allowed under these provisions. If it is a revenue expenditure, it will be allowed. Now an expenditure can fall either under category A or category B or category C. Category A expenditure is expenditure which is allowed as per the provisions of the Act, right? So we should ensure that such expenditure is deducted in computing income under the head PGBP. If it has already been deducted, that means it is already debited in the P&L account, no further deduction is required. But if it is not deducted, if it is not debited to P&L account, then we should allow for the deduction. For example, cost of raw material is allowed under section 37.1. So the expenditure is allowed. A second category of expenditure will be expenditure which is not allowed. That means which is disallowed. For example, income tax paid is not allowed under section 48(2)(i), right? In such case, we should ensure that such expenditure is not deducted in computing business income. If it has been debited or if it has been deducted in computing net profit as per P&L account, we should add it back. If it is not deducted in the first place, then no adjustment is required, no add back is required. The third category of expenditure is the expenditure which, although it is allowed generally, but in certain cases it is disallowed. So for example, if we have interest on bank loan, though it is allowed generally under section 36(1)(3)(i), but it is subject to compliance with section 43B. So if it is paid after the due date to furnish return of income for that previous year, section 43B is not complied with, and therefore such expenditure is disallowed. It is not allowed as a deduction. In that case also, we need to follow the same approach as that for category B. We will now look at various deductions which are allowed in relation to assets, right? So this is the theme. And we will look at sections 30 and 31, which provide for deduction for rent, rates, taxes, repairs and insurance for premises, machinery, plant or furniture. Then we will look at depreciation. Then we will look at section 35 AD, which is investment linked tax incentive for specified businesses. And then we will look at deduction on account of insurance premium for stocks or stores. So we first look at section 30 and 31, which allow deduction in respect of certain expenditure for premises, machinery, plant or furniture which is used for the purposes of the business or profession. So if this is not used for the purposes of business or profession, no deduction is supposed to be allowed. Let's look at this table. Section 30 deals with premises, section 31 deals with machinery, plant or furniture, and deduction depends on whether the assessee is the owner or the tenant. Now there are 5 items. Firstly, land revenue, local rates or municipal taxes are allowed as deduction in respect of premises, whether the assessee is the owner or the tenant. but this deduction is subject to compliance with section 43B, and we will discuss 43B in this video. For now, we just need to keep in mind that if 43B is not complied with, deduction is not allowed under this provision. Second, insurance premium against the risk of damage or destruction is allowed as deduction in all the cases. In all the cases. Rent, it is also allowed as a deduction where the assessee is a tenant, right? But rent for machinery, plant and furniture is also allowed, but it is not allowed under section 31, right? It is not covered by section 31, rather it is allowed under section 37(1), which deals with general deduction. So in effect, rent is allowed as a deduction. Now repairs can be either revenue in nature or capital in nature. If repairs are revenue in nature, these are allowed as deduction in all the cases. But if repairs are capital in nature, then these are not allowed as deduction. These are not allowed as deduction. But the repairs which are capital in nature, depreciation may be allowed on that. So such expenditure may be added to the actual cost of the asset, and consequently depreciation under section 32 can be claimed in respect of that. In case of a tenant, if the tenant incurs expenditure on repairs which are capital in nature, so we will look when we talk about depreciation that depreciation is allowed only when the assessee is the owner of the asset. The tenant is not the owner of the asset. So in this particular case, what about deduction on account of repairs which are capital in nature? Deduction will not be allowed under section 30, and it will not be allowed under section 32 also, depreciation, because the tenant is not the owner. But there is a specific provision which has been made. In such case, in the case of building, that is the premises, right? If expenditure of capital nature on repairs is incurred by the tenant, it is what? It is deemed to be the building owned by the tenant for the purpose of depreciation. So even if the tenant is not the owner, right, that expenditure, that structure, right, is deemed to be the building owned by the tenant, and consequently depreciation is allowed even to the tenant. So what is the summary? In summary, all the aforesaid expenditure is allowed as a deduction except what? Repairs which are capital in nature, on which depreciation can be claimed under section 32. Now the assessee may be the tenant in respect of the premises or the asset, right? So he is incurring expenditure on payment of rent, which is allowed as a deduction, and he may sublet the premises or asset to any other person, and then he will recover some rent from that person. So the effective deduction on account of rent will be what? Rent paid by him minus rent recovered by him. So that will be the effective expenditure, and therefore the deduction will be rent paid minus rent recovered. Now, as we noted above, the deduction under section 30(31) is allowed if the premises, machinery, plant or furniture is used for the purposes of the business or profession. Consequently, what happens? If, say, the premises or the asset is not used for the purpose of business or profession, deduction is not allowed. Say premises used as residence for personal purposes. Second, if the premises or asset is not exclusively used for the purpose of business or profession, then a proportionate deduction is allowed having regard to its use. For example, 60% of the building is used for office and 40% as residence. So only 60% of the rental expenditure will be allowed as a deduction. Now we will look at the provisions of depreciation. Relevant section is section 32. Relevant rule is rule 5. Right? First, we will look at the conditions to claim depreciation. 3 conditions need to be satisfied in order to claim deduction on account of depreciation. The asset should be 1. A specified asset. So any asset which is not a specified asset is not entitled to depreciation. What is a specified asset? It can either be a tangible asset or an intangible asset. If it is a tangible asset, it needs to be a building or machinery or plant or furniture. If it is an intangible asset, it needs to be know-how or patent or copyright, trademark, license, franchise, or any other business or commercial right of similar nature. But goodwill is not covered. Goodwill of a business or profession is not covered, so depreciation is not allowed in the case of a goodwill of business or profession. So asset should be a specified asset. Secondly, asset should be owned by the SSE, and the SSE can own the asset either wholly or partly. If the SSE doesn't own the asset at all, depreciation is not allowed. Third, the asset should be used for the purposes of business or profession. If the asset is not at all used for business or profession, there is no depreciation. Now let's look at each of these three conditions. Certain points which are relevant to note. Condition 1, that the asset should be a specified asset. This is the first condition. No depreciation is allowed on land. Okay, land is not a specified asset, so depreciation is not allowed. Why? Because land generally doesn't depreciate, the value appreciates. Building includes not only the building per se, but also roads, bridges, culverts, wells, and tube wells. Plant. What is a plant? It refers to a tool of trade. What is a tool of trade? Tool of trade is anything that is necessary to carry on business or profession or any operation or process, right? As per section 43.3, plant also specifically includes and does not include certain items. What are those items? Plant specifically includes ships, vehicles, for example, motor car, books, for example, books of a lawyer, books of a chartered accountant, right, are the tool of trade. These are necessary to carry on the profession. So books are plant. Scientific apparatus and surgical equipment used for the purposes of business or profession. But plant does not include certain items. What are they? Tea bushes, livestock. Okay, so plant doesn't include tea bushes, livestock. It also doesn't include buildings of furniture and fittings. Why? Because buildings, furniture and fittings are a separate category of specified asset. So they are not included in plant as such. Now, as far as intangible asset is concerned, we saw that certain specified intangible assets are there, and then we have any other business or commercial rights of similar nature on which depreciation is also allowed. What is this category? This category includes rights which can be used as a tool to carry on business. One example, a stock exchange membership card. So the SSE, who is a member of, say, the BSE, Bombay Stock Exchange, he has acquired a stock exchange membership card, and the expenditure incurred in acquiring that card is entitled to depreciation under section 32. As we noted above, goodwill is not entitled to depreciation. Revenue expenditure is not entitled to depreciation since it is not capitalized. For example, stock in trade. It is not entitled to depreciation. Full deduction in respect of stock in trade as business expenditure is anyways allowed. Any capital asset which is not specified is not entitled to depreciation. For example, shares or securities. Depreciation is not allowed on shares or securities. So only assets which are specified are entitled to depreciation. Second condition for claim of depreciation is that the asset should be owned wholly or partly by the SSE. And what are the points that one should note in this respect? Registration of the asset in the name of the SSE is really not necessary to say that the SSE is the owner for the purposes of claim of depreciation. The SSE need not be the registered owner for claim of depreciation. Then what is relevant? What is relevant is that the SSE should exercise the rights of the owner in his own right. As we noted above, ownership may be exercised by the SSE not just fully but also partly. So therefore, not only the owner but also the co-owner can claim depreciation. If there is a co-owner, then depreciation is allowed to the extent of his share. Now, there will be a land on which the building will be constructed or the building will stand. While for claiming depreciation on a building, it is necessary that the SSE should be the owner of the building, but the SSE need not be the owner of the land on which the building is constructed. What about lease? In the case of lease, depreciation is not allowed to the lessee, it is allowed to the lessor because lessor is the owner. And this is the position whether the lease is an operating lease or a financing lease. This is clarified by Circular 2 of 2001. What about the cases of hire purchase? Where the asset is purchased by way of a hire purchase agreement, and then there are hire charges. Payment is supposed to be made in installments, and there are hire charges which are also required to be paid. Now the depreciation is allowed not to the lessor but to the lessee. That is the person who is acquiring the asset by way of hire purchase. On the cash value. Cash value is what? The sale price as on the date of agreement. That is the sale price, right? What about the hire charges? Hire charges are deductible over the term of the agreement. So two components, hire charges and the cash value. Depreciation on cash value and deduction over the term of the agreement in respect of the hire charges. So this is Circular 9 of 1943. We noted in our discussion on sections 30 and 31 that if there is a expenditure on capital repairs by the tenant, he is deemed to be the owner of that particular structure which arises, and depreciation is allowed. So let's see, what is this? If the SSE does not own the building, say if the SSE is the lessee or the tenant, and he incurs capital expenditure for purposes of business or profession. What kind of capital expenditure? Either he constructs a structure or any work by way of renovation or extension or improvement to the building, right? For instance, he constructs an additional floor on the building and he's a tenant. So expenditure is capital in nature, right? Then that structure or work is deemed to be the building owned by the SSE. So even if the SSE, not being the owner, doesn't own the building, but that structure or work is deemed to be the building which is owned by the SSE, and consequently depreciation is allowed to him even if the SSE is not the owner of the building. Clear? Now we come to condition 3, which is that the SSE should use the asset for the purposes of business or profession for claim of depreciation. The asset must be put to use for the purposes of business or profession, and it can be put to use at any time during the previous year. So even if the asset has been acquired on 31st March of the previous year and it is put to use on 31st March just for a day, then also depreciation for that year is supposed to be allowed. Now what is put to use? Does it mean active use or does it also mean passive use? Active use means that there is a, say for example, a fire extinguisher. Fire extinguisher has been purchased and there is a fire and we use the fire extinguisher to extinguish the fire. So it is active use. But if there is no fire, so there is no occasion to use the fire extinguisher. So the fire extinguisher is ready to be used, but it is lying, it is not actively used. That is called passive use. So when we talk about the condition of use, both active as well as passive use are included. Right? Thus, even if the fire extinguisher is kept ready for use, though not actually used, depreciation is allowed because it can be said to have been put to use. Now, depreciation is not optional. The SSE cannot say that I don't want depreciation. Depreciation is mandatory, it is compulsory, it is supposed to be allowed whether or not the SSE has claimed deduction in this respect. Now we will talk about methods to compute depreciation. What are the methods as per which we need to compute the amount of depreciation to be allowed as deduction? And there are two methods. The first method is the straight line method or the SLM method. This is available to an undertaking which is engaged in generation and distribution of power, to a power undertaking basically. As per this method, depreciation, what is the formula for computing? Actual cost of asset multiplied by the percentage rate of depreciation. So this is allowed on actual cost year on year, right? So 1000 rupees is the actual cost, 10% is the rate of depreciation. So rupees 100 is allowed, right? And then again 100 is allowed, and so on till the time actual cost becomes 0. Therefore, total depreciation cannot exceed the actual cost of the asset. The undertaking can also opt for the WDV method, which is the written down value method, which we will talk, instead of SLM method. And this option needs to be exercised in the previous year in which it begins to generate power and before the due date of filing return of income for that previous year, right? So that is an option. If that option is not exercised, SLM method applies. SLM method applies to the power undertaking. In all other cases, and this is the general case, and mostly all the questions are based on this particular method. Depreciation is allowed on WDV method or the written down value method. And here block of assets is relevant. This concept becomes important. So what we need to do, what is the formula? Written down value of the block of assets multiplied by percentage rate of depreciation. So as far as SLM method is concerned, what is important is the actual cost of the asset, right? But in the case of WDV method, what is important is WDV of the block of assets. So block of assets is not relevant in the SLM method, right? In the SLM method, the actual cost of the individual asset is seen. But in the WDV method, the individual asset loses its identity and it falls, all the assets within a particular group fall within a particular block of assets. So they lose their individual identity. And then basis the written down value of the block of assets, depreciation is computed. Now we will discuss the concepts of block of assets, actual cost, and computation of written down value. Block of assets. Now, as we noted above, depreciation is computed at the prescribed percentage of written down value of the block of assets. So individual assets lose their own individual identity and they get assimilated within a particular block of assets. Depreciation is computed on the written down value not of that individual asset but of the block of assets. Now the question arises as to what is the meaning of block of assets. So block of asset means a group of assets falling within a class of assets in respect of which the same percentage of depreciation is prescribed, right? So what we need to figure out? We need to figure out what is the class of assets. Within a class of assets, there may be several rates of depreciation which have been prescribed. For each rate of depreciation, several assets may fall. That becomes a block of assets. For example, let's say item number 6. The class is what? The class is plant and machinery, right? And as you can see, the rate is 40% for all the type of assets which are enumerated in this number 6. So this becomes a block of assets because now it comprises a group of assets, all these assets, a group of assets falling within a class of assets. What is the class? Plant and machinery, in respect of which the same percentage of 40% rate of depreciation has been prescribed, right? So accordingly, a total of 10 block of assets can arise based on the classes and the rates which have been prescribed. So as far as the classes are concerned, there are 4 classes as you can see in this table: building, furniture and fittings, plant and machinery, and intangible assets. And within each class, we have different block of assets. So for example, in the class buildings, there are 3 blocks of assets which arise. Number 1, in respect of residential buildings, right? For example, residential quarters for employee in a manufacturing compound. So residential buildings, but except hotels and boarding houses, the lowest rate of 5% is prescribed. For non-residential buildings, for example, office building, a higher rate of 10% is prescribed. And for purely temporary erections, such as wooden structures, which are temporary in nature, not permanent, the highest rate of 40% is prescribed. So 5%, 10%, 40%, 3 rates are prescribed in respect of the class of buildings. Now we come to furniture and fittings. Furniture and fittings, there is only one block of assets because the rate of depreciation is only one, which is 10%. And furniture and fittings includes electrical fittings as well. It includes electrical fittings. These includes things like electrical wiring, switches, sockets, and other fittings, fans, etc. So all these are included within the class furniture and fittings. Now we come to the third class, which is plant and machinery. In the plant and machinery, we have the maximum number of block of assets. 5 block of assets arise. right? And the rates range from 45% and go down till 15%. Now in certain cases you will see a star, star, star. What is a star? Wherever the star is there, that means the particular asset should be acquired and put to use during a specified period. And all these specified periods end before 1st April 2020. So that means that if we are talking about purchase or acquisition made during the previous year, say 22-23, it would be after this specified period. So the asset which are denoted by star won't apply to those purchases made where the acquisition and put to use is completed on or after 1st April 2020. Now let's look. Number 5, bus, lorry and taxi which is used in the business of running on hire. So there is a star. So if there is a current purchase for say previous year 22-23, this won't apply. What will apply then? Then the bus, lorry or taxi which is used in the business of running on hire, it will basically fall here. Bus, lorry, taxi used in business of running on hire, and instead of 45%, the rate of 30% will apply. Rate of 40% applies for aircraft, commercial vehicles, and again there is a star for commercial vehicles, pollution control equipment, life-saving medical equipment, containers, energy-saving devices, renewable energy devices. What is important for us for exam point of view is also computers, including computer software and books. See, this is in bold. That means these are generally asked in the exam. So whenever in the exam you have an asset which is a computer or computer software or books, then you need to apply 40% rate of depreciation. What about printers, routers, etc.? What is the rate of depreciation there? So computers includes peripherals like printer, scanner, NT server, UPS, router, etc., which form an integral part of the computer. That is also included in the meaning of computer, and consequently 40% depreciation rate is provided. Then we come to the next block for which a rate of 30% is there, and this includes bus, lorry or taxi used in the business of running on hire, and motor car which is not used in the business of running on hire, and there is a star. That means the end date of 1st April 2020, right? So motor car, for example, motor car purchased for office purpose, so it's not used in the business of running on hire, but there is a star. So if this asset is acquired say in previous year 22-23, then where will it fall? It will fall here. Motor car not used in the business of running or hire, and then instead of 30%, the rate of 15% will apply. Ships are entitled to 20% rate, and then finally we have oil wells, motor car which is not used in the business of running on hire. So generally in the question, if you have a motor car which is purchased, and if it is not given that the motor car is used in the business of running on hire, that means it is a general motor car. So for all general kinds of motor cars, 15% rate applies. And for any other plant and machinery, that means this is the general rate, 15%. So 15% is the general rate, not only for motor car, the general category of motor cars, but also it is the residual rate for all other plant and machinery. For computers and books, computer software and peripherals like printers, etc., 40% rate is there, right? This is what we need to remember. As far as the fourth class of intangible assets goes, there is just one block because only one rate of depreciation is there, which is 25%. So these are the various block of assets. So in the question, you will have a list of various assets, and then you need to first figure out what are the different blocks that will arise, and then you need to keep in mind these various rates of depreciation that are allowable. Now in the question, sometimes the rate of depreciation may not be given. In that case, we should assume the general rate. So if it is a case of building, we can assume the general rate of 10%. If it is a case of plant and machinery, we can assume the general rate of 15% and proceed. For furniture and fittings and intangible assets, the rate will always be 10% and 25% because there is just one block which arises. So having noted the concept of block of assets, we will now see the method of computation of normal depreciation. Why normal depreciation? Because depreciation can either be the regular depreciation, which we call normal depreciation, right? When it is on the written down value method, then it is section 32(1)(2)(i). And it can be additional depreciation under section 32(1)(2)(ia), which we will discuss in some time. So now here we are talking about computation of normal depreciation. So what are the steps to compute depreciation? First of all, we determine the opening WDV of the block as on 1st April of the previous year. So this is the opening WDV. To that, we add the actual cost of assets acquired during the previous year. Right? What is the actual cost? We will look at this in some time. Then we deduct monies payable for assets which are disposed of during the year. Right? They are sold or discarded or demolished or destroyed during the previous year. What is it that we reduce? The price for which the asset is sold, or the insurance claim that is received, or the salvage money, or the compensation money, or the scrap value which is received. So money is payable for assets disposed of during the previous year, that is reduced. So opening WDV plus actual cost and less money is payable. And so actual cost of assets acquired and money is payable for assets disposed of, this is what we do in respect of the entire previous year. And the result is what? The result is the WDB of the block as on 31st March of the previous year. And this is the WDB on which depreciation is computed and allowed. So on this WDB, we compute depreciation. And what is depreciation? WDB of the block as on 31st March of the previous year, which is this particular amount, multiplied by the percentage rate of depreciation, and then we deduct the amount of depreciation, and finally what we get is the closing WDB of the block for the relevant previous year. This closing WDB of the block in turn becomes the opening WDB of the block as on 1st April of the subsequent or the next previous year. So this is how we calculate depreciation. Now, as far as deduction of monies payable for assets disposed of is concerned, we need to note 3 points. WDV cannot become negative on account of this deduction. So if the opening WDV of the block as on 1st April is say 100 rupees, there are no acquisitions during the previous year, and say the monies payable on account of disposal is 125 rupees, WDV cannot become minus 25. It will become nil, and consequently no depreciation will be allowed, because the WDV on which depreciation is supposed to be allowed becomes nil. Only monetary consideration is deductible because the words are monies payable. Non-monetary consideration is not deductible. Only the monies payable is deductible. Fair market value of the asset which is disposed of is not deductible. So depreciation is what we deduct from the written down value to arrive at the closing WDV of the block of asset. So what we need to note is only depreciation which is actually allowed is deducted from the WDV to arrive at the closing WDV for the relevant previous year. We will see after some time that sometimes depreciation may be allowed not to the full extent but only to 50% extent. In that case, only the 50% depreciation which has actually been allowed will be deducted under this table, not the full depreciation. Now we look at the quantum of depreciation. Quantum of depreciation. The depreciation that we saw we need to calculate under this table. As per step 5, what is the quantum of depreciation that needs to be allowed? Now this depends on the period for which the asset has been put to use during the year for the purposes of business or profession. And there can be 3 possible situations. Situation 1, where the asset acquired during the previous year. Where the asset acquired during the previous year is not put to use for business or profession in that previous year. So asset is acquired but it is not at all put to use. And put to use, as we noted, means not only active use but also passive use. In that case, there is no question of depreciation and therefore no depreciation is allowed. Second will be a situation where asset is acquired during the previous year and it is put to use for business or profession for at least 180 days in that previous year. 180 days means basically half of the year. So at least 180 days right? 180 days or more. In that case, full depreciation is allowed for that previous year. So if 1000 is the, say, the actual cost of the asset which has been acquired, and there is no asset in the block of asset, this is the only asset, and the rate of depreciation is 10%, then full depreciation is allowed, which is 100 rupees. If the asset was, say, put to use, say, on 1st of July, in that case, put to use is at 180 days or more in that previous year, right? And therefore, the full 10% depreciation will be allowed. But if the asset which is acquired during the previous year is put to use for business or profession for less than 180 days in that previous year, for example, in this case, if the asset was, say, put to use on 1st March of the previous year, that means only for a month, so it is less than 180 days. In that case, depreciation is restricted to 50%. So instead of 100, only 50 rupees will be allowed as depreciation. Quantum of depreciation as per this particular chart is something which is different than the actual cost of assets which is acquired during the previous year. As we saw in the table above, when an asset is acquired during the previous year, we figure out the actual cost, and that actual cost is added. The actual cost is added, right? So whether or not the asset is put to use, it doesn't matter whether the asset is put to use for less than 180 days or 180 days or more. It doesn't matter. If the asset is acquired, then the actual cost needs to be added to the value of the block, right? But when we come to computation of depreciation, then this particular chart becomes relevant. So either no depreciation will be allowed, or 50% will be allowed, or full depreciation will be allowed. So don't mix up both these things. The other important point is, as far as this 50% restriction of depreciation is concerned, it is applicable only in the year of acquisition and not to the subsequent years, right? So for example, if in the first year the asset is acquired on 31st March and put to use on 31st March, that means only for one day. So 50% depreciation will be allowed for that year, but next year full depreciation will be allowed. Similarly, if that asset is, say, not put to use on 31st March, so no depreciation will be allowed in the first year, but next year again full depreciation will be allowed, because 50% restriction applies only in the year of acquisition, not to subsequent years. Now, just for ready reference, you may note the date of 3rd of October, right, in the context of 180 days. So the condition of usage for 180 days or more will be satisfied if the asset is put to use latest by 3rd of October. So if the asset is put to use on, say, 3rd of October of the year or any earlier date, then full depreciation will be allowed. If the asset is put to use on any date during the previous year after 3rd of October, then 50% depreciation will be allowed. In case the year is a leap year, then 3rd October will become 4th of October. These are the dates which you can remember for ready reference purpose. Now, we noted above that actual cost is an important component in the computation of depreciation. If it is a case of power undertaking where SLM method applies, then depreciation is computed on actual cost. If it is a case of WDV method on the block of assets, right, then while computing WDV, the actual cost of assets acquired during the previous year needs to be added. So actual cost is an important concept, and therefore we need to understand what is the meaning of actual cost and how do we compute it. In nutshell, what is the actual cost? It means the actual cost to the SSE. It means the actual cost to the SSE. And what is the objective? The objective is to capture all expenditure which is necessary to bring the asset into existence and put it in working condition. So, basis this objective, now we note the table which lists down the steps to compute actual cost. So basically there are 3 steps. In step 1, we first pick up the actual cost of the asset to the SSE. And what will this be? This will either be the purchase cost where asset is purchased, or construction cost where the asset is constructed. So we begin with this. Secondly, we add the following items if they are not forming part of the actual cost, because they are supposed to form part of actual cost. So if they are already forming part of actual cost, we need not add them further. What are these items? First is on account of interest. The SSE may, say, borrow funds to acquire the asset and pay interest on those funds. So interest in connection with the acquisition of the asset is supposed to be added to the actual cost, because depreciation is supposed to be allowed on that cost. But there is a cutoff. The cutoff is the date the asset is first put to use. So till the date asset is first put to use, interest is capitalized and therefore added to actual cost. After this date, interest which falls for the period after the date the asset is first put to use doesn't form part of the actual cost. Rather, such interest expenditure is fully deductible under section 36(1)(3)(i), which we will discuss shortly in this video. Right? So there is this loan which has been taken on this particular date and the asset is first put to use on this particular date. So interest which is payable from this date to this date is added to actual cost, and interest which is payable from this date to this date is deductible under section 36(1)(3)(i). Next, expenses which are incurred to acquire and bring the asset to the site. Right? So for example, heavy machinery. So what are the expenses? Freight, insurance, carriage, loading, unloading, etc. So all these are in the nature of direct costs. So we add these expenses to the actual cost. Third, expenses to install the asset. So we pay installation charges, technician fees, etc. All these are supposed to be added to the actual cost. Fourth, expenses to facilitate the use of the asset. And sometimes we may also need to modify the asset to make it fit to use. All such costs are added provided these expenses are incurred before the asset is put to use. After the asset is put to use, they can be claimed as part of general expenditure under section 37(1). Now the third and the last step is to reduce certain items if they form part of actual cost, because they are not supposed to form part of actual cost. Depreciation is not allowable on such items. If they are anyways not forming part of actual cost, no further reduction needs to be made. What are these items? Firstly, GST on which input tax credit has been allowed. Double benefit cannot be allowed. Either you claim ITC or you claim depreciation. So if ITC has been allowed, depreciation cannot be allowed. So you need to reduce it from the actual cost. Similar is the situation for excise and customs duty as well. Second, the assessee may receive say subsidy or grant or reimbursement from say the government, which may be a central government or state government, or from any statutory authority or from any other person, whatever it may be. For what? To meet the cost of the asset. So since that subsidy, grant or reimbursement go towards reducing the cost of the asset, it is not supposed to be the part of actual cost of the asset. And lastly, we need to disallow or exclude that component of expenditure from the actual cost which exceeds rupees 10,000 and where the payment has been made by a non-specified mode. Specified modes are account pay check or demand draft, bank ECS, credit card, debit card, net banking, IMPS, UPI, RTGS, NEFT, and Bhima Aadhaar Pay. The concept of this specified mode is something that we will look at in various provisions, and the list of specified modes will remain the same. So carefully look at this list. So this list is the list of payment by specified modes. If the payment has been made by specified mode, then whatever be the amount, it doesn't matter, it forms part of actual cost. But if the payment is not by a specified mode, for example, if the payment is by cash, or say by uncrossed check, or say by cross check, therefore it's not an account pay check, or say by bearer check, then we need to see whether the payment exceeds 10,000, right? And is the payment made to a person in a day? To a person in a day, in that case, to that extent, the amount needs to be excluded. So if 20,000 has been paid for freight for bringing the asset to the site, and the payment is made to the transporter in a single day, right, by cash, so it is non-specified mode, it exceeds 10,000, it is to a person in a day, and therefore 20,000 should not form part of the actual cost. If it forms part, it needs to be deducted. So once the amount exceeds 10,000, then not just the excess above 10,000, but the entire amount needs to be disallowed. Now this is the method of computing actual cost, whether normal depreciation is claimed or whether additional depreciation is allowed, or whether it is allowed as per the WDV method or as per the SLM method. The concept of actual cost remains the same, and this is how we compute actual cost. So we looked at the method by which we compute the normal depreciation, and now we will look at additional depreciation, and this is provided by section 32(1)(2)(ia). By additional depreciation, what we mean is that this is in addition to the normal depreciation that we have learned so far. What is the quantum of additional depreciation? It is 20% of the actual cost of new plant and machinery. So it is allowed on plant and machinery. On new plant and machinery, we figure out the actual cost, we compute 20% of that actual cost, and that is the amount of additional depreciation. So it is in addition to the normal depreciation. There are two basic conditions which need to be fulfilled, that the plant and machinery should be acquired and installed after this particular date. So 2005 is 31st March 2005 is the date. So in all the cases, and for the current previous year, the acquisitions will fall under this particular provision. So they will satisfy this condition. Secondly, which is a more important condition, is that the SSE should be engaged in certain business. What is the business? A, in the manufacture or production of any article or thing. Right? So service industry is not covered. In the manufacture or production of any article or thing, or generation, transmission or distribution of power. So either the undertaking should be in the power business or in the manufacture business or in the production business. Now there is a negative list for additional depreciation, and in respect of that list, additional depreciation is not allowed. And the reason is basically to ensure that the plant and machinery is new, or that it is actually used in the process of manufacture or production, or in the generation, transmission or distribution of power. So ships and aircraft, no additional depreciation. Second-hand plant and machinery, no additional depreciation, right? If it is used within or outside India by any other person, then additional depreciation is not allowed. Plant and machinery which is installed in any office premises or in any residential accommodation, and this includes a guest house, then additional depreciation is not allowed. For example, computers installed in office. Office appliances or road transport vehicles. Road transport vehicles, for example, a motor car, additional depreciation is not allowed. And lastly, if the actual cost of the asset has been allowed as a deduction to the SSE, if 100% of the actual cost has been allowed as deduction, then additional depreciation is not allowed. In that case, even normal depreciation is not allowed. Right? And such deduction may be allowed by way of depreciation or even otherwise. For example, scientific research expenditure. If there is a machinery which has been purchased, so capital expenditure on scientific research, and if 100% deduction is allowed in respect of actual cost under section 35, then additional depreciation is not allowed. So this is the negative list, and we need to especially note this list and keep this in mind. What about 50% restriction, where the asset is put to use for less than 180 days during the previous year? And this is something that we saw in the case of normal depreciation, that 50% restriction is there. Similar is the case for additional depreciation as well. In that case also, additional depreciation is restricted to 50%. That means it is allowed at the rate of 10% in the year in which put to use is for less than 180 days. What about the balance 10%? It is allowed in the next year. Now additional depreciation is not available where SLM method is being followed by a power undertaking. But as we noted above, even power undertakings are eligible for additional depreciation. So what is that case? That is the case where the undertaking has opted to follow the WDV method, right? But where that is not the case and SLM method is applicable, then additional depreciation is not available. What about the case of an SSE which is engaged in the business of printing or in the business of printing and publishing? The question is whether this amounts to manufacture or production also. There is a circular 15 of 2016 where the CBDT has clarified that it amounts to manufacture or production, and therefore such SSE is also eligible for additional depreciation. It is calculated on the same actual cost of the asset in both the years, 10% in year 1 and 10% in year 2. What happens in case of normal depreciation? 50% is allowed in year 1, but full depreciation is allowed in year 2, and 50% restriction is not applicable to subsequent years. It is only applicable into the year of acquisition. This is what we noted while discussing the concept of quantum of depreciation. And again, the normal depreciation in the second year is allowed basis the written down value of the block of assets, not on the actual cost of the asset. Number 6, there is a negativeness for additional depreciation, right? And number 6, additional depreciation is available only on plant and machinery. So what this means is that additional depreciation is not available on building, furniture and fittings and intangible assets. But normal depreciation is available on all these specified assets. And lastly, additional depreciation is disallowed on assets forming part of the negative list. There is a negative list, but for normal depreciation, there is no such negative list. As far as negative list is concerned, only thing which is common is something which pertains to point number 5 of the negative list. That is where 100% of the actual cost has already been allowed as deduction. Then additional depreciation is not allowed. Even normal depreciation is not allowed in such case, because double deduction of for the same actual cost is not supposed to be allowed. Now we noted above that in the case of power undertaking, the SLM method of depreciation applies unless such undertaking has opted for the WDV method in the first year in which the business begins. Now in such case, as we have seen, depreciation is equal to actual cost of the asset multiplied by the percentage rate of depreciation. And therefore what this means is that the concept of block of assets does not apply in such case, and depreciation is computed separately for each asset on its actual cost year on year basis, right? And therefore depreciation is not calculated on WDV but on actual cost. What this also means is that total depreciation cannot exceed the actual cost of the asset, right? We keep on allowing depreciation till the actual cost becomes 0, and after that depreciation is not allowed in respect of that asset. Now what about 50% restriction where put to use is for less than 180 days? Does it apply in this case also? Yes, it applies. So this 50% restriction applies even where SLM method is followed by the power undertaking. As we noted above, in respect of additional depreciation, it is not allowed where SLM method is followed. But where the power undertaking has opted for WDV method, it can claim additional depreciation as well. Now there is a special treatment when the building, machinery, plant or furniture is disposed of. That means it is sold, discarded, demolished or destroyed in the year other than which it is first put to use. And this is not very much important for an exam perspective, so we will just briefly make a reference here. What we need to look at is the monies payable together with the scrap value, if any, right, on account of the disposal, and then we need to see what is the written down value of the asset. So for example, if 1000 is the actual cost and 100 is the depreciation, then 900 becomes, say, the written down value of the next year. Then again we apply 100 on the basis of SLM method, and 800 becomes the written down value. So written down value keeps decreasing as we keep allowing depreciation on SLM method. So we need to compare monies payable with the written down value of the asset. And then if there is shortfall, that means where monies payable is less than the WDB, then that shortfall is deductible as terminal depreciation. Section 32(1)(3)(i). But where money is payable is greater than WDV, then what is taxable is the balancing charge. It is called balancing charge, and this is under section 41(2). And further under section 50A, capital gains also arises if there is a further excess, right? So we will not talk about this in detail, though there is an illustration also which is given in the tax book, but we will quickly move on to the next topic. Now there is a special provision which deals with a situation where there is a change in foreign currency exchange rate, and this is dealt with by section 43A. So the asset may be acquired by the SSE not only from within India but also from outside India, right? And it may be acquired with the help of, say, amount borrowed from any person from outside India in, say, any foreign currency, or by way of a foreign supplier's credit. That means a foreign supplier says that, look, you need not pay the entire amount at the time of purchase, you can pay it after some time, right? So there is a foreign supplier's credit. So when the asset is acquired, there will be a particular rate of exchange at that particular date. And if the payment is, say, made at a later point of time, then there will be a rate of foreign exchange and there will be a foreign currency exchange rate on this date as well. And this, the rate as on this date and rate as on this date may not necessarily be the same, right? So there can be likely a variation. This is called exchange rate fluctuation, right? And the payment will be made on this particular date when the foreign exchange currency rate is not the same as the rate which was prevailing on the date when the asset was acquired. And therefore, compared to the liability, there will be a difference in respect of the amount which is paid. It can be lesser or it can be higher. Logically, when there is such variation, then the actual cost also should be adjusted so that the amount of depreciation can be aligned to the revised actual cost. This is what is the purpose of section 43A. And there are three conditions which need to be satisfied. So section 43A covers a particular situation, right, where three elements are required to be satisfied. What are those elements? Number one, the SSE has acquired any asset in the previous year from a foreign country, not India, from a foreign country for the purposes of his business or profession. Okay. Second, how is the asset acquired? The asset is acquired through monies borrowed. So the money has been borrowed and then using that money, asset has been acquired. The money has been borrowed from any person, but in a foreign currency. Or the asset has been acquired by way of a foreign supplier's credit, right? So there is a credit period and the money can be paid after some time, right? It need not be paid at the time of acquiring the asset. Third, there is a change in the rate of exchange. There is a change in the rate of exchange during any previous year after the acquisition of the asset. So the asset has been acquired, but after the acquisition of the asset in a later previous year, there is a change in the rate of exchange. And consequently, because of the payment of such liability on that later date, because there is a change in the rate of exchange, there is also an increase or decrease or reduction in the liability of the SSE. And this is compared to what? This is compared to the liability which existed at the time of acquisition of the asset. So asset was acquired, right? And this was the liability based on the foreign currency exchange rate prevailing at that particular date. And then there is a payment which happens in a later previous year. And there is a change in the liability of the SSE time of making the payment. Why? Because there is again a change in the foreign currency exchange rate. And the amount paid may be less or more than the liability which was incurred when the asset was acquired. And therefore adjustment is required to be made. And what is the adjustment? The amount by which the liability is increased or reduced and which is taken into account at the time of making the payment is added or deducted from the actual cost of asset. So if the liability increases, then that amount is added to the actual cost. If the liability decreases, then that amount is deducted from the actual cost, and consequently the depreciation will subsequently be claimed on the revised actual cost. So the amount of depreciation will become aligned to the revised actual cost. So we revise the actual cost basis the fluctuation in the foreign currency exchange rate. This is the objective of section 43A. Now what we note here is that this adjustment under 43A is not made every year. It is made only in the year in which the payment is done, right? Thus, even if there is a foreign exchange gain or loss in the interim years, adjustment is not made. Adjustment is made to the actual cost only in the year of payment. And when the payment is made, the rate needs to be compared between two dates. What are those dates? we need to compare the exchange rate at the time of acquisition of the asset. That is the original rate, and the exchange rate prevailing at the time of making the payment. That is the subsequent exchange rate. We need to compare both the rates, and then we figure out the gain or the loss, which is then adjusted finally to the actual cost of the asset in the year in which the payment is made. So this is about section 43A. Now we come to certain cases where actual cost is determined in a particular specific manner. Right, so actual cost is determined in certain special cases, and there are certain cases, but we are going to discuss only those particular situations which are important from an exam perspective. So first is on account of gift or inheritance. What is the situation? The asset is acquired by the assessee by way of gift or inheritance. So what is the actual cost? Because no amount is paid by the assessee to acquire the asset, gift or inheritance. So how do we determine the actual cost? Because when we determine the actual cost, we will include it in the computing the WDV of the block of assets, and then accordingly we will grant the depreciation. So we need to compute the actual cost. How will actual cost be computed? We first find out the actual cost to the previous owner, right, from whom the asset has been acquired by way of gift or inheritance, so the previous owner. And then we deduct notional depreciation. Notional depreciation, and what is that? Depreciation that would have been allowable to the assessee as if the asset was the only asset in the relevant block of assets. We assume that the asset is the only asset, right? And accordingly we compute the depreciation which would have been allowable, and we deduct that notional depreciation from the actual cost to the previous owner, and that becomes the actual cost to the assessee. And consequently, fair market value of the asset which is acquired is not relevant. We then move on to the other situation, which is a case of private building. So this provision applies to a building, not to any other asset. So a building is previously the property of the assessee, and it is brought into use for the purposes of the business or profession. So for example, it is a private property not being used for business or profession. Say it is my own residence. So I cannot claim depreciation. But now I convert that residence into my office. Now I am using it for my business or profession. So now I can claim depreciation. So the point is, what is the actual cost which I should consider now? So how is the actual cost computed? It is the actual cost of the building. And then we deduct notional depreciation. And what is that? Depreciation that would have been allowable had the building been used for the business or professional purposes since its acquisition. So we assume as if the business had been used for business or profession, and then we allow that amount of notional depreciation, and finally we arrive at the balance which is taken to be the actual cost to the assessee in the previous year in which the building is brought into use for the purpose of business or profession. So from the year of acquisition till the date of bringing it into business or profession, we compute notional depreciation and we allow deduction of that notional depreciation. So what we need to note is the fair market value or stamp duty value of the building is not relevant. We compute the actual cost basis this particular formula. The other important point is this special provision only applies to a building. It doesn't apply to any other case. So for instance, there is a motor car, a private motor car used for personal purpose, and now it is used for business purpose, right? So the actual cost of that motor car will be taken without deducting notional depreciation. This provision applies only in the case of a building. Lastly, we will look at a case where the assessee has agricultural income. So assessee is engaged in agricultural business, and as we noted in the video on exempt income, agricultural income is exempt from tax, but there can be a case where a processing is performed which is way beyond the compulsory processing. Process other than compulsory process is performed, in which case composite income arises, which is a consolidated income comprising two parts: agricultural income which is exempt from tax and business income which is taxable, and then we need to split the composite income and tax the component of business income. Now what will happen in such case is that depreciation will be allowed in computing business income, right? But only a part of income is treated as business income because we split the composite income, not the entire income is treated as business income. So only the proportionate depreciation will be allowed, full depreciation will not be allowed. Now, how do we determine the WDV of the asset? Because as we noted in the table some time back for computing depreciation, that we figure out the WDV. On that WDV, we calculate depreciation, we deduct the depreciation, and that brings us to the closing WDV of the year, which then becomes the opening WDV of the next year. Now we are talking about this depreciation, and accordingly, how do we arrive at this particular amount, which becomes the opening WDV of the next year? Should we allow deduction of the full depreciation, or should we allow depreciation which is actually allowed, which is not the full depreciation but only the proportionate depreciation having regard to the ratio of business income? That is the question. So here what the special provision says, section 43(6), is that for computing the WDV of assets acquired before the previous year, what we do is that the total amount of depreciation is computed, not the proportionate depreciation. Total depreciation is computed as if the entire income was business income. So we compute the total amount of depreciation, and that total amount of depreciation is deemed to be the depreciation actually allowed. Because what we learned a short while ago is that the depreciation which is actually allowed is required to be deducted here, right? And therefore the question is that the full depreciation is not actually allowed, only the proportionate depreciation is actually allowed. But by virtue of this special provision, the full depreciation is deemed to have been actually allowed. So we deduct not the proportionate depreciation, but the full depreciation, and accordingly we arrive at the closing WDV, which becomes the opening WDV of the next year. So the depreciation that will be allowed in computing the total income will be the proportionate depreciation, because it's a composite income. But when we compute the WDV, we will allow the full depreciation. We will deduct the full depreciation and not the proportionate depreciation. An illustration is also given, but we are not going to go into this illustration because it is not in the scope of this video. So this brings us to the end of the topic on depreciation. We will now talk about section 35 AD. And this is in the nature of an investment linked tax incentive, right? Tax incentive or a tax deduction which is linked to the investment made in what? In a specified business, right? So we will look at the provisions of section 35 AD now. Now section 35 AD allows the whole, so 100% or the whole of the expenditure is allowed as deduction. It allows the whole of any capital expenditure. So revenue expenditure is not allowed as deduction. Capital expenditure is allowed as deduction under 35 AD, which is incurred by the assessee for the purposes of any specified business. So there are certain specified businesses. Only in respect of those businesses, 35 AD is allowed. For all other businesses, 35 AD is not allowed. Deduction is allowed if specified conditions are fulfilled. We will look at those conditions. And a negative list of expenditure is specified, which is not entitled to the deduction. Now, what is the quantum of deduction? Deduction under section 35 AD is equal to 100% whole of what? Of any expenditure of capital nature, which is incurred. How? It is incurred wholly and exclusively. For what? It is incurred for the purposes of any specified business, right? And such specified business should be carried on by the assessee during the previous year. So the business should be a specified business. It should be carried on by whom? By the assessee when? During the previous year. And expenditure should be incurred. What kind of expenditure? Capital expenditure. Wholly and exclusively, right? Not indirectly. Wholly and exclusively for what? For such a specified business. Then 100% of the whole of such expenditure is allowed as deduction in that year in which it is incurred. Okay, so it is a very good tax incentive provided to specified businesses. Now, when we talk about capital expenditure, several items of capital expenditure will likely be incurred before commencement of operations of the business. What about those expenditure? Will they not be allowed any tax incentive? So the provision says that yes, they can also be allowed deduction under 35 AD. So what does 35 AD say? That if an expenditure is incurred prior to what? Prior to the commencement of operations of the specified business. So prior to the date when the operations of a specified business commence. So capital expenditure incurred prior to that date, it is also allowed as deduction. But when? When? In which year? In the previous year in which the operations commence. In the previous year in which operations commence, the pre-commencement capital expenditure for that specified business is also allowed as deduction. But there is a condition. What is the condition? The condition is that such amount, right, which is the pre-commencement capital expenditure, it should be capitalized in the books of accounts. When? As on the date of commencement of operations. So this is what we need to check in the question, that if there is a pre-commencement capital expenditure, whether it is capitalized in the books on the date of commencement of operations. In that case, 100% of that expenditure as well is allowed as deduction when in the previous year in which operations commence. So that expenditure is not deferred or allowed in installments in subsequent years. It is allowed in full in the previous year in which the operations commence. So the question is, what are the specified businesses? So there is a whole list of specified businesses, and this is given in the table. You may not need to remember this entire list because generally in the question there will be a reference to section 35AD. So you will come to know that the business that we are talking about in the question is the business which is a specified business under 35AD. But at least there are certain points which you need to keep in mind. For example, if we are talking about a warehousing facility, then it can be either for storage of agricultural produce or it can be for storage of sugar. If we are talking about a hotel, it will be covered if it is 2-star or above. If we are talking about a hospital, it will be covered under 35AD if it has at least 100 beds for patients, right? At least 100 bedded hospital, at least 2-star category hotel, or warehousing facility in respect of agricultural produce or sugar. So these are some of the things that we can keep in mind. And also, a new infrastructure facility is entitled to 35AD tax incentive. So developing of infrastructure facility or maintaining and operating of infrastructure facility or developing, maintaining and operating of infrastructure facility, this is also covered. So it will be good to just keep in mind this list of 14 items as well, even though otherwise in the question there will be a reference to 35AD. Now there are certain basic conditions which need to be fulfilled in order to claim 35AD deduction. And the specified business should fulfill all of the following conditions, and there are 3 basic conditions. The first condition is that the specified business should be carried on by the SSE when? During the previous year in which expenditure is incurred. So if capital expenditure is incurred but specified business is not carried on, 35AD is not available for that previous year. Second, it should be actually in the nature of a new business. That means it should not be old wine in a new bottle. So what the provision says that this specified business should not be set up by splitting up or reconstruction of an already existing business. It should be a newly set up business. Third, the idea is that the specified business should be set up using new plant and machinery, not second-hand plant and machinery. So what is the condition? Specified business should not be set up by transfer of plant and machinery previously used for any purpose, second-hand plant and machinery, right? But there is a relaxation. What is the relaxation? Relaxation is provided up to 20% of the total value of plant and machinery. So up to 20% of total value can be second-hand, but the rest needs to be new plant and machinery. Now, mind you, this particular condition number 3 applies only in respect of plant and machinery, not in respect of any other capital expenditure, right? There is another exception or relaxation which is provided in the case of second-hand imported plant and machinery, and this is something that we will not discuss in detail in this video. So 3 basic conditions: that the specified business should be carried on in the previous year in which expenditure is incurred. Second, it should not be a case of splitting up or reconstruction of an existing business. Third, it should be formed by transfer of new plant and machinery, right? But there is a relaxation in terms of 20%, up to 20% of total value of plant and machinery, which can be second hand, but the rest needs to be new. Now there is a negative list as well. There is a negative list as well. And negative list means that deduction under 35AD is not allowed in respect of certain expenditure. And there are two items. First, and this is the same as we discussed for in the context of computing the actual cost of the asset for claim of depreciation. What is not allowed? If there is any expenditure which is more than, which exceeds 10,000, for which the payment is made by a non-specified mode and which is made to a person in a day, right? So if 20,000 rupees is paid for acquiring, say, a machine, and the payment is made to a person in a day, then that 20,000 is disallowed, and therefore 35AD deduction is not allowed in respect of this particular expenditure. So this is the same as that we discussed for purpose of computing actual cost of the asset. Second is, if it is a case of land or goodwill or financial instrument, 35AD is not allowed in respect of expenditure on acquisition of these items, these assets. We may note that even depreciation is not allowed in respect of land or goodwill or financial instrument, because these don't form part of the specified list of assets for which depreciation or even additional depreciation is allowed. Right, so as far as land, goodwill or financial instrument is concerned, depreciation is not allowed, additional, whether normal or additional, and even 35AD is not allowed. Barring this negative list, 100% of all other capital expenditure incurred for any specified business is allowed deduction under section 35AD, provided the above stated basic conditions are fulfilled. Now we need to carefully make a note of the implications of claiming deduction under section 35AD. If we claim and we are allowed deduction under 35AD, then what are the implications? Now the implication can be in the context of the specified business, and they can be in the context of the expenditure. Now as far as the context of a specified business is concerned, the deduction can either be claimed and allowed under section 35AD or under section 10AA and chapter VIAC. Okay, so either you can claim deduction here or you can claim deduction here. You cannot claim tax incentive or deduction under both the cases, right? So if you claim deduction under section 35AD, you will not be allowed deduction under 10AA and chapter VIAC. Similarly, you can claim deduction under section 10AA and VIAC, but in that case you won't be allowed deduction under section 35AD. What is 10AA? This is tax incentive or tax deduction for special economic zone units. This is something that we have discussed in the video on exempt incomes. What is chapter VIAC? This is the deduction which is given under chapter VIA from the gross total income. From the gross total income, and this is what we will look when we do the video on deductions allowable from gross total income. Now, in this particular aspect, the point that needs to be noted that when we look at the deductions from gross total income under chapter VIA, there are parts of the chapter VIA. So, chapter VIA B, chapter VIA C, chapter VIA CA, and chapter VIA D. The bar which we are referring above is only in respect of chapter VIA C. Chapter VIA C, it doesn't apply to other parts. So for example, if deduction is claimed under 35AD, the assessee will still be allowed deduction under chapter VIA-B. What is VIA-B? It comprises sections 80C to 80GGC. All these deductions will be allowed. Chapter VIA-CA deductions will be allowed. What are these? 80TTA, 80TTB. And VIA-D deduction will also be allowed. What is this? Section 80U. What is not allowed is only chapter VIA-C deduction. Is only chapter VIA-C deduction. Right? So, if deduction is claimed and allowed under 35AD, then these deductions will not be allowed for such specified business. When? For the same or any other assessment year. So either you claim deduction under 35AD or under 10AA and VIAC. Now, what are the implications of deduction in respect of expenditure? Okay. Now, if the deduction is claimed or has been opted and has been allowed to the assessee under 35AD for an expenditure. So if an expenditure is allowed deduction under 35AD, then what happens? Then a double deduction cannot be allowed. That means such expenditure cannot be allowed as deduction under any other provision in any previous year, or even under 35AD for any other previous year. That means an expenditure can be allowed as a deduction only once. Double deduction is not possible, whether in the same year or whether in any other year. What this means is that if 35AD is claimed for an expenditure, you cannot claim depreciation, whether normal depreciation or additional depreciation in respect of that expenditure. Now, important point to note is 35AD deduction is optional. It is not compulsory. And that's what we saw. You can either claim deduction under section 35AD, in which case you won't be allowed deduction under 10AA and chapter VIAC, and also double deduction of the same expenditure will not be allowed. So 35AD is optional, it is not compulsory. Okay. Now there is a lock-in period of 8 years which has been prescribed. Why? Because the government wants the assessee to continue to use the asset for which 35AD has been allowed for a minimum period of time in the specified business. So what the provision says is that if an asset has been acquired, capital expenditure has been incurred, and deduction has been claimed and allowed under 35AD, then that asset should be used only for the specified business for the period of 8 years, which is the lock-in period. And this period begins when? It begins with the previous year in which the asset was acquired or constructed. In other words, the previous year in which the 35AD deduction was claimed. Right? After the lock-in period, you can do anything, whatever you want, but you should continue to use this asset for 8-year lock-in period. Now, if there is a default, that means if the asset is used for a purpose other than the specified business during the lock-in period, then implications arise. And what is the implication? Deemed business income arises, and therefore it is taxable as business income. And when does it arise? It arises in the year of default. That means when the asset is used in default for other than the specified business. So effectively, what is the business income that becomes taxable? It is the total deduction which was claimed and allowed under 35AD. So effectively, the 35AD deduction which was allowed earlier is reversed. It is clawed back, right? But you can say that at least give me the deduction of the depreciation as per section 32, which I would have been allowed if I would not have claimed deduction under 35AD, right? So at least give me that deduction. If you are reversing 35AD deduction, then at least allow me section 32 depreciation deduction for that period. So we deduct the amount of depreciation allowable under section 32 as if no deduction under 35AD was allowed. So we compute the depreciation that would have been allowable and we deduct this amount of depreciation. That means the balance 35AD deduction is reversed, right? So effectively, while you are reversing 35AD deduction, you are actually allowing the depreciation for those years. As if 35AD was not allowed, depreciation under section 32 would have been allowed. So this is the amount of deemed business income, right? So effectively, you reverse 35AD deduction, but in turn, you allow the depreciation under section 32 in respect of that asset. Now, when we compute depreciation under 32, which is supposed to be deducted or which is indirectly supposed to be allowed, then that is computed up to which previous year? It is computed up to the previous year prior to the previous year of default. Not till the previous year of default, but prior to the previous year of default. So if asset was acquired in say year 1, asset was acquired in year 1, and this is the lock-in period of 8 years, right? And in the 6th year, this is the, say, 6th year. This is 7th year and this is the 8th year. So in 6th year, you start using the asset in some other non-specified business. So there is a default, right? So you reverse the 35AD deduction, which was allowed in year 1. And you compute the depreciation starting from this year till this year, right? And you indirectly allow this depreciation by making a deduction of depreciation allowable. And the balance is the deemed business income, which you tax when? In this particular year, 6th year, right? Because this is the year of default. So this is how this works. Now this deemed business income does not arise when? If there is no default, And what are those situations? Where say the asset is used in any non-specified business, but after the lock-in period. So the condition, the restriction is only till the lock-in period. Say in the ninth year, you move this asset out of the specified business and move it to a non-specified business. It doesn't matter because you have already complied with the lock-in period. So no implication arises and deemed business income doesn't arise. This also doesn't happen where the asset is used in another specified business, right? So even if say in the sixth year, you move this asset out of say one specified business and start using it in another specified business, because both the businesses are specified businesses, it doesn't matter. Deemed business income doesn't arise. So hope this is clear. Now impact on depreciation. What is the impact? So there could be two situations which are possible. So there is a default during the lock-in period. Asset is used for other than the specified business during the lock-in period. That means this is a case of default, right? In which case, what happens is that deemed business income arises, right? And indirectly, we also allow depreciation till the year prior to the previous year of default, because we have deducted the amount of depreciation while computing deemed business income. But what about depreciation on and from that year? So on and from the sixth year in our case. Can we claim depreciation? Yes, we can claim, because now we have already added the deemed business income. So that chapter is over. Now we begin the normal chapter, because now asset is being used in a non-specified business. So depreciation can be claimed under section 32. So deemed business income arises, but depreciation can now be claimed from the previous year of default. Now when we claim depreciation, we will need to bring that asset and add its actual cost while computing the written down value of the block of assets. So the question will be how to compute actual cost. How to compute actual cost? So actual cost will be computed in the same way as if we have been, computing and claiming depreciation all the way along. So this is how we will compute actual cost. So it will be the actual cost to the SSE when the asset was acquired or constructed, and then we will deduct depreciation all throughout this period. That means that would have been allowable if the asset was used for the purpose of business since its acquisition, right? So this will be the actual cost. So we will deduct notional depreciation. So it will be as if the depreciation had been claimed all the way along, and what is the balance will become the actual cost, and the asset will be added to the relevant block of asset at this figure of actual cost, and from there on we will start claiming the depreciation on the written down value of the block of assets as per the normal provisions. Okay. So if there is a default within the lock-in period, a deemed business income arises and depreciation can be claimed from the previous year of default. And mind you, when we compute deemed business income, we deduct the amount of depreciation allowable all through this time. So indirectly we are allowing the depreciation as well. So indirectly we are allowing the depreciation claimed, which would have been claimed all throughout this particular period. And from the previous year of default, we claim depreciation as per the normal provisions. And how do we compute actual cost? For computing actual cost, we adopt the same method. Actual cost minus the notional depreciation. That means depreciation as if it was allowed to the SSE all the way along. And in the previous year of default, we arrive at the actual cost, and that is what we add while computing the written down value of the block of assets. The second situation could be where the asset is used for other than the specified business, but after the lock-in period of 8 years. That means it is not a case of default. It is not a case of default. So when it is not a case of default, deemed business income does not arise. Deemed business income does not arise. So 35 AD has been claimed to the extent of 100% of actual cost. Deemed business income also does not arise. So what is the actual cost? Now when we are bringing the asset after the lock-in period of 8 years, anytime thereafter, into some other business, right? And we need to figure out the actual cost to add to the block of assets. What is the actual cost? Actual cost is taken to be nil, right? Because 100% 35 AD has already been allowed, and we are not reversing 35 AD also because there is no default. Since the actual cost is nil, depreciation cannot be claimed. In that case, no depreciation is allowed. So no implication on account of depreciation. Is it clear? Now we talk about the case where there is a disposal of an asset. For example, the asset is demolished or destroyed or discarded or transferred, sold, and we receive some sum. And 35AD has been allowed. So we acquire a capital asset, we claim 35AD deduction for 100% of the actual cost, and after some time, we dispose of the asset. We transfer it, we sell it, or it is demolished, destroyed, etc. So whatever we receive is actually a kind of a gain. So that amount is taxable as business income of the year of disposal. 8-year lock-in period is not relevant. There is no time limit for this provision. Why? Because it is simply a gain. We were already allowed deduction of 100%, and now whatever be the time, whenever be the time, we are disposing it off and we are receiving something. So that amount is taxable as income under the head PGBP. Now quickly coming to the summary of depreciation, we saw various aspects relating to the grant of depreciation, and this is a summary. What is the situation and what is the impact on depreciation? Now, we cover a situation where, say, asset is acquired for a specified business and 35AD has been allowed. So 100% of the cost has been claimed under 35AD. Now what happens? Three situations can arise. Asset is used for a specified business, right? So 35AD was claimed, 100% of actual cost, and asset is used for a specified business. So as we noted earlier, depreciation is not allowed because double deduction is not possible. Okay, this is one. Second, asset is used for a purpose other than the specified business during the lock-in period. So as we noted above, there is a default. And what we saw is that business income arises in the year of default, plus now the depreciation is allowed. It can be claimed from the previous year of default. Clear? Third, asset is used for a purpose which is other than the specified business, but after the lock-in period of 8 years. So there is no default. But 35AD deduction has already been allowed to the extent of 100%. So therefore, even after the asset has been brought into use in any other business, depreciation is still not allowed because actual cost is taken to be nil. This is what we noted some time back. Now coming to the second category where the asset is acquired for a non-specified business. As the SSE is acquiring the asset for a non-specified business. But from whom? From the owner who had availed deduction under 35AD. So the previous owner had acquired the asset and he got 100% deduction under 35AD. Now he gives the asset to the SSE by way of a gift or by way of a will or by certain other transfers which are specified under section 47. So there is no cost as such to the SSE, and the previous owner has availed 100% deduction under section 35AD. In that case, 100% deduction has been allowed by the government to a previous owner, and there is no actual cost per se to the SSE who is acquiring the asset. So what the government says is that the SSE will still not be allowed depreciation because the actual cost to the SSE will be taken as nil. Okay, the government cannot grant deduction under section 35AD or on account of depreciation to multiple SSEs. So in the case of SSE, the actual cost will be taken to be nil, so no depreciation. In other cases, there is no special implication because it is a case where a non-specified, because where the asset has been acquired by the SSE and it is used in non-specified business, so 35AD doesn't come into the picture at all, and therefore depreciation is allowed as per the regular provisions which we discussed under the topic of depreciation. So finally, two small points to note. There is a compliance requirement in terms of audit. So SSE needs to get the accounts of the specified business audited for the previous year in which 35AD is claimed. And there are some special provisions in regard to carry forward instead of loss in specified business, but this is something that we will discuss in detail in the video on carry forward instead of losses. Now we look at section 36(1)(i), insurance premium for stocks or stores. You remember sections 30 and 31 where we dealt with insurance premium for premises, plant, machinery or furniture. Stocks or stores was not covered in that. So here is this section 36(1)(i) which provides for a deduction of insurance premium which is paid in respect of stocks or stores which are used for the purposes of the business or profession. So with this, we come to the end of the theme as far as deductions in respect of assets are concerned. Now we will move to the next theme, which is on provisions governing amortization. Now there are three provisions which provide for amortization of expenses. One is on preliminary expenses, second is on VRS expenditure, and third is on family planning expenditure. And now let's look at each of these three categories of expenses. Preliminary expenses are covered by section 35D. Section 35D provides for amortization of specified preliminary expenses over a period of 5 years subject to a specified limit. The benefit of this provision applies to whom? If the SSE is a company, the SSE should be an Indian company, not a foreign company. If the SSE is other than a company, then the SSE should be resident in India, not a non-resident. Now, specified expenditure should be incurred during a particular period. What is that period? Either it should be incurred before commencement of business, or it should be incurred after the commencement of business. But in such case, it should be in connection with the extension of an undertaking or in connection with setting up a new unit. Now, what is the quantum of deduction? 1/5 of the specified expenditure is deductible in 5 annual equal installments, right? So, specified expenditure which has been incurred within this particular period, 1/5 of that, we figure out 1/5 and then we allow deduction in 5 equal annual installments. And what is the first year from which deduction starts? The deduction starts or begins with the previous year in which the business commences. The business commences or extension of the undertaking is complete or the new unit commences production or operation, right? And this is referred to as the first previous year. So first previous year plus 4 subsequent previous years, it means 5 previous years and all. So we need to figure out or determine the amount of specified expenditure because that amount is then amortized over a period of 5 previous years. So there are 7 items in the list of specified expenditure. Expenditure in connection with preparation of feasibility report or project report, conducting market survey or any other survey which is necessary for the business, engineering services. Number 4 is legal charges for drafting any agreement, right? So 1, 2, 3, 4 items of expenditure can be incurred by any eligible SSE. Maybe a company, may not be a company. But as far as items 5, 6 and 7 are concerned, they should be incurred by a company. So they apply only to an SSE, which is a company. And what are these items? Legal charges for drafting memorandum of association or article of association and on its printing, fees for registering the company under the Companies Act, and expenditure in connection with public issue of shares or debentures of the company, right? So these are the 7 items of expenditure. So from 1 to 4, expenditure can be incurred by a company as well as a non-company SSE, but 5, 6 and 7 apply only to a company SSE. Now, who should carry out this work? The work which is referred or the expenditure which is incurred under items 1 to 7, who should carry out this work? So all of these can be carried out by the SSE himself, So whatever expenditure the SSE himself incurs, that becomes a specified expenditure. The SSE can also outsource the work to a concern, but where the expenditure falls under items 1, 2 and 3, the concern should be approved in this behalf. But the requirement for approval of the concern is absent for item numbers 4, 5, 6 and 7. So the concern needs to be approved only for item number 1, 2 and 3, not for the other items, right? So this is the manner in which we determine the expenditure, which is a specified expenditure and which is in consonance with this criteria and which has been incurred within the period that is covered by section 35D. So once we have determined the amount of specified expenditure, we need to figure out that is there any limit in terms of the specified expenditure, because there is a limit to the amount that can be allowed as a deduction under section 35D. So it cannot be unlimited. So there is a cap. What is the cap? Total expenditure. So whatever total specified expenditure that we compute, it cannot exceed. It cannot exceed what? If the SSE is an Indian company, it cannot exceed 5% of either the cost of the project or the capital employed in the business of the company. So the company has an option to take either 5% of cost of project or capital employed. So obviously the company would like to compute both A or B and then take the higher of A or B, and 5% of that will result in a higher limit for the company. In case of others, that means for an SSE which is not a company, 5% of cost of the project is the limit. So 5% of cost of the project is the criteria in terms of limit for all the kinds of SSEs. But for a company SSE, there is an additional option in terms of 5% of capital employed in the business. So capital employed is relevant only for a company SSE, not for others, right? So therefore, it becomes important to look at the meaning of cost of project and the capital employed. So here is the meaning. What is the cost of the project? Cost of the project is equal to the actual cost of fixed assets. The actual cost of fixed assets. And this actual cost should be as shown in the books of the SSE. When? On the last day of the first previous year. First previous year is what we saw here is the first previous year in which the deduction starts. So that is the first previous year, right? So not the first day of the first previous year, mind you, it is the last day of the first previous year, right? So on the last day of the first previous year, as per the books, whatever is the actual cost of fixed assets, it is taken as the cost of project. And it includes expenditure on development of lands and buildings as well. Now in the case of company, there is an additional criteria in terms of capital employed. What is capital employed? Share capital that is issued plus debentures plus long-term borrowing, not short-term borrowings, long-term borrowings as on the same day. Which date? Last day of the first previous year. So we add all these up and that brings us to the amount of capital employed. Need to keep in mind that reserves and surplus is not included within the meaning of capital employed. Now, the question may arise as to what is the meaning of long-term borrowings. So, long-term borrowings means either one or two. What is one? Money is borrowed from the government or IFCI or ICICI or any bank or any financial institution. Or if the money is borrowed or debt incurred in a foreign country for purchase outside India of capital, plant and machinery, the term should be 7 years or more. The term should be 7 years or more. So either one or two, right? And we aggregate both and that becomes long-term borrowing. So what we do is, first of all, just for a quick recap, we first identify the coverage in terms of period that we are looking at. Then for this particular period, we identify the items that are in the nature of specified expenditure. And then we aggregate that. Further, we find out what is the maximum limit. So for that, we figure out cost of the project and capital employed. And then in the case of Indian company, we compute 5% of the higher of cost of project or capital employed. For others, we compute 5% of cost. And this is the cap. This is the upper limit. Accordingly, we determine the amount of eligible specified expenditure. And finally, we compute 1/5 of that. And then we allow deduction of that 1/5 installment on an annual basis, beginning with the first previous year. Right? There is this compliance requirement regarding furnishing of audit report, and there is this bar on double deduction. So If the expenditure is allowed as a deduction under this particular provision, then it is not allowed as deduction under any other provision. The next provision for providing amortization is 35 DDA, which deals with VRS expenditure, and it applies to all the SSEs. Amortization is allowed of payment of any sum to an employee in connection with his voluntary retirement, which is in accordance with a scheme of voluntary retirement. So if an SSE makes payment of any sum to an employee in connection with voluntary retirement, amortization of that sum is allowed. Amortization of that sum is allowed over 5 annual installments. So therefore we compute 1/5 of the sum and we provide deduction in 5 annual installments beginning from the previous year in which such sum is paid. There is no double deduction which is allowed, and therefore if the sum is allowed as deduction under this provision, then it is not allowed as deduction under any other provision. The third provision for amortization of expenses is 36(1)(ix) for 36(1)(9), and this relates to family planning expenditure. So if an expenditure has been incurred by a company SSE, so this provision doesn't apply to a non-company SSE. If the expenditure is incurred by a company SSE and the expenditure is bona fide, that means it is a genuine expenditure. For the purpose of what? For the purpose of promoting family planning. Promoting family planning, but only amongst its employees. Then in order to encourage such promotion, the government has allowed a special provision in respect of this particular expenditure. And 36(1)(9) says that if the expenditure is revenue in nature, then 100% of deduction is allowed. 100% of deduction is allowed for revenue expenditure. But if the expenditure is capital in nature, then it is amortized in 5 annual installments. That means 1/5 in each previous year, beginning with the previous year in which it was incurred. So basically, expenditure, if it is incurred for non-employees, is not covered by this provision. Secondly, a non-company SSE is also not covered by this provision. However, does that mean that a non-company SSE cannot claim deduction in respect of such expenditure at all? It can claim. If the expenditure is capital in nature, then it can explore depreciation under section 32. If the expenditure is revenue in nature, then it can claim the deduction under section 37(1), which deals with general expenditure. Of course, the conditions for claim of depreciation and under section 37(1) should be satisfied. If they are satisfied, the non-company SSE can claim the deduction under those respective provisions. If it is a case of company SSE, then this is the special provisions, and we need to follow this special provisions for a company SSE. So this was about the provisions regarding amortization of expenses. We will now cover expenditure for special purposes, and we will cover expenditure on scientific research, contribution for rural development and urban poverty eradication, and payments by state government undertakings. So first we look at expenditure on scientific research, and deduction is provided by section 35, right? Section 35 allows deduction in respect of expenditure on scientific research which has been incurred by the SSE, and the SSE can incur such expenditure in two ways. One, by conducting scientific research in-house, or by making payment to outside entities for this purpose, and deduction is allowed on both these counts. Further, where the asset which is used for scientific research is subsequently sold, then deemed profits also arise in terms of section 41(3). So we will look at this provision as well. So first we look at the deduction in respect of payment to specified entities. For that, 100% deduction is allowed. 100% deduction on account of payment made to certain entities for scientific research is allowed. So let's look at this. 100% deduction is allowed for sum paid to the following entities. Situation 1, where the sum is paid to either of 1, 2, 3 or 4. Research association, but not all research association, which has as its object the undertaking of research, or a university or a college or other institution. And these entities should be approved and notified. The mnemonic for purpose of quick learning, you can use RICU. recoup. Now the sum which is paid to these entities should be used for scientific research or statistical research or research in social science, right? If that is the case, then 100% deduction of the sum paid is allowed under section 35. Second category, sum is paid to a company, but the company should be registered in India, not outside India. And the company should have its main object of scientific research and development. And the company should be approved, right? Further, the sum should be paid to be used for scientific research. If that be the case, 100% deduction is allowed. Now, there could be a situation where after the payment has been made by the SSE, right, the approval which has been granted to these entities has been withdrawn. So what will happen to the deduction? In that case, it is provided that the deduction will not be denied merely on this ground. The third category is where the sum is paid to either a university or the national laboratory or an IIT or an approved person. And the mnemonic which you can use is UNIA, right? The sum should be paid with a specific direction. So there should be a specific direction. And the sum should be paid with a specific direction that the sum shall be used for what? For scientific research, which has been undertaken under a program which is approved, right? Now there could be a situation where after the payment has been made, right, the program itself is withdrawn. The program for which the sum was paid is itself withdrawn, or the approval which was given to the program is withdrawn. But it is provided that deduction will not be denied merely because of this reason. So this is the deduction which is provided in respect of these three categories for sum which has been paid by the SSE to outside entity for the purpose of scientific research. Next category is that of expenditure on in-house scientific R&D. And let's look at this chart to get a clear idea of the provisions. Where in-house expenditure has been incurred on what? On scientific research. Related to what? Related to the business of the SSE. So if the scientific research is not related to the business of the SSE, it has got no connection whatsoever, then deduction is not allowed even if the expenditure is in-house. So the scientific research should be related to the business of the SSE and there is an in-house expenditure that has been incurred by the SSE. If the expenditure has been incurred after the commencement of business, that means while the business is running, then the expenditure can either be capital in nature or revenue in nature. If the expenditure is of revenue nature, 100% is allowed as a deduction in the year in which the expenditure is incurred. If the expenditure is capital in nature, even then 100% deduction is allowed in respect of that capital expenditure. But the expenditure should not be on land. So if the expenditure is on land, no deduction is allowed in that respect, right? Deduction is also allowed in a case where the in-house expenditure has been incurred before the commencement of business. But there is a timeline. It is not open-ended. What is the timeline? The expenditure should have been incurred within a period of 3 years, immediately preceding the commencement of business. Not the previous year of commencement of business, but the date of commencement of business. So we move 3 years back immediately preceding that date of commencement of business. And we figure out what is the amount of expenditure that has been incurred. And the whole of that expenditure is then allowed as a deduction in one previous year. But in which year? In the year in which business is commenced, right? Now in the case of pre-commencement expenditure, the expenditure again can be of two types. If it is capital in nature, then 100% of that is allowed as deduction in the year in which business is commenced. But if the expenditure is revenue in nature, then only two categories of expenditure are allowed. Only two types of expenditure are allowed as deduction. And what are those? One, payment of any salary to an employee engaged in scientific research. So SSE would be engaging employees and would be making payment of salary, and salary doesn't include perquisites. Salary doesn't include perquisites. So barring perquisites, the payment of salary, expenditure on that will be allowed as deduction. Secondly, the SSE would purchase materials to be used in scientific research. That expenditure will also be allowed as deduction. But the condition for allowance of this expenditure in both the cases of salary and material is that it should be certified by the prescribed authority. So expenditure which is not certified will not be allowed. Expenditure which is certified will be allowed. Except for salary and material, all other expenditure will not be allowed as deduction. Deduction is not supposed to be allowed. For salary and material, 100% of deduction is allowed under section 35. Right? So after commencement of business, capital and revenue expenditure 100%. But expenditure on land, no deduction. Pre-commencement, capital expenditure except land, 100% deduction. Revenue expenditure, only salary and material expenditure which is certified is allowed 100% deduction, else the other revenue expenditure is not allowed as deduction. Now if deduction has been allowed under section 35, then for that capital expenditure, depreciation is not allowed, right? Double benefit cannot be claimed. So either you claim 35 or you claim depreciation. In the context of depreciation, we noted that there is a condition of asset to be put to use for 180 days or more for full claim of depreciation, and if it is less than 180 days put to use, then 50% depreciation can only be claimed. But this particular provision is not there for the context of section 35. So section 35 deduction is allowed whether or not the asset is put to use, whether it is put to use for less than 180 days, 180 days or more, or whether it is not put to use, it doesn't matter so long as expenditure is incurred. Full deduction under section 35 is allowed. Now we will look at the provisions of section 41(3). Now there will be a situation where an asset has been acquired for scientific research by the SSE and it is subsequently sold. It is subsequently sold, and there can be two possible situations. Situation number one, where the SSE has acquired the scientific research asset, and then the SSE would claim the deduction of 100% under section 35, and then the asset is sold. The asset is sold and it is not used for any other purpose. So it is used for scientific research, the deduction is claimed, and without having been used for any other purposes, it is sold. In that case, deemed profits arise under section 41(3). And what is the quantum of such deemed profits? It is the lower of what? Sale proceeds or the deduction made under section 35, which would have been at the rate of 100% of cost of the asset when it was acquired. So lower of sale proceeds or deduction made under section 35. When is the deemed profit taxable? In the year of sale. What if the business is not in existence in that year? What if the business for which the asset was acquired is not in existence? It has ceased to exist. Even then, deemed profits under section 41(3) are taxable. Even then, they are taxable. Further, on top of this, capital gain will arise on sale, which will be computed as per the provisions of capital gain. Situation 2 will be a situation where the scientific research asset is sold, but after being used in the business. So the SSE acquired scientific research asset, claims depreciation of 100% under section 35, and then scientific research project is over and the asset is moved to be used in the other parts of the business. Now when the asset is used in the business, after it ceases to be used for scientific research, right, it enters the business, it enters the normal course of business, and therefore the SSE would like to claim depreciation. Depreciation becomes admissible. But the SSE has already claimed full deduction under section 35, so effectively depreciation cannot be claimed. So what will happen? The asset, when it comes into the normal business, it is added to the relevant block of assets, because of course it will be added to the relevant block of assets. But at what actual cost? At nil actual cost. So that effectively in respect of that asset, depreciation will not be allowed to be claimed by the SSE, but it will enter the relevant block of assets at nil actual cost. Why nil? Actual cost of asset minus 100% deduction allowed under section 35. So this will be the first part. In the second part, when the asset is subsequently sold. Now since the asset is a part of block of assets, what will happen? Capital gain will arise. And since capital gain will arise in respect of depreciable asset, the capital gain will be computed under which section? Under section 50. Section 50, we will discuss about this in the video on capital gain. So these two aspects need to be taken care of. So these are the two situations in when the asset is sold, which is used for scientific research. So these are the provisions with respect to scientific research. The next deduction is allowed under section 35 CCA, and it is allowed for what? For payment of any sum to either rural development fund, which is set up and notified by the central government, or to the National Urban Poverty Eradication Fund, which is also set up and notified by the central government. And thirdly, we have section 40A to IB, which deals with payments by state government undertakings, but we will not discuss this in this video because it's not very much relevant from an exam perspective. And now we move to our next theme, which is deduction on account of interest. We will cover provisions on account of interest on borrowed capital and also on account of discount on zero coupon bonds. So let's see interest on borrowed capital first, and the relevant section is section 36(1)(3)(i) or 36(1)(3). And for this, let's look at this chart, which will give you a great deal of clarity. So interest is paid in respect of capital borrowed. And now first we need to see what is the purpose for which the capital is borrowed. Whether the capital is borrowed for the purposes of business or profession, or whether the capital is borrowed for personal purposes. If the capital is borrowed for personal purposes, that means it has got no connection with business or profession, and therefore deduction is not allowed. But where the capital is borrowed for business or profession, then we need to further check whether the loan or borrowing is from a bank or public financial institution or state financial corporation or state industrial investment corporation or NBFC, non-banking finance company. If the loan or borrowing is from a bank, PFI, SFC, SIIC or NBFC, then deduction is allowed under this provision, which is section 36(1)(3)(i). But this is subject to compliance with section 43B. That means the interest should be actually paid, and we will discuss section 43B in the due course in this video. If section 43B is not complied with, deduction is not allowed. If section 43B is complied with, deduction is allowed under section 36(1)(3)(i). If the loan or borrowing is from any other person, that is other than bank, PFI, SFC, SIIC or NBFC, then the condition of 43B doesn't apply and deduction is allowed under section 36(1)(3)(i). For example, loan taken from a friend, right? So this is the provision regarding deduction of interest. Now there is another angle to it. If the interest is paid because capital has been borrowed for acquisition of an asset, right? So depreciation will be allowed on that. Now what we need to see, the period from the date interest starts until the date the interest period ends. We need to bifurcate this particular period into two parts. The first part is till the date on which asset is first put to use. Till the date, not the previous year, till the date on which the asset is first put to use. And in such case, we have already discussed this in the discussion on depreciation, that interest till this period is added to the actual cost of the asset. That means it is not allowed as a deduction under section 36(1)(3)(i), but it is added to the actual cost and consequently depreciation can be claimed. Thereafter, that means from this point onwards, that is after the date on which asset is first put to use, deduction is not added to the actual cost, rather it is allowed as a deduction under section 36(1)(3)(i). And when it is allowed under section 36(1)(3)(i), then we need to consider these provisions. And as per these provisions, we need to allow deduction under section 36(1)(3)(i). Now, it is not always necessary that interest is payable because the capital has been borrowed. Interest may be payable even when capital has not been borrowed. For example, interest on delayed payment to vendor for purchase of goods. Right? You purchase goods from the vendor and there is a delayed payment, and then you need to pay interest to the vendor. But it cannot be said that you have borrowed capital from the vendor, but interest is supposed to be paid. So under which provision will deduction be allowed for that interest? It will not be allowed under section 36(1)(3)(i) because it is not capital borrowed, but it will be deductible under the general deduction provision of 37(1). What about expenses like brokerage, commission, etc., which are paid to arrange the loan? They are not covered under 36(1)(3)(i), but deduction can be claimed under the general deduction provision of 37(1). Now we also need to keep in mind that when the assessee is making payment of interest, there is this angle of deducting TDS. Tax needs to be deducted at source under certain provisions in respect of payment of interest. And the relevant provision is section 40A iiia regarding disallowance of expenditure if the conditions with regard to a deduction and payment of TDS are not fulfilled. We will discuss 40A and IA in the due course in this video. But then in such case, the deduction under section 36(1)(3)(i) will be subject to 40A and IA if tax is deductible at source. If there is no question of TDS, the 40A and IA will not come into play, and straight away we can allow deduction as per the provisions of 36(1)(3)(i). But if TDS angle is there, then we also need to consider the provision of disallowance under section 40A and IA. The next provision is on account of amortization of discount on zero coupon bonds, and this is section 36(1)(3)(ia) read with rule 8C. Now an assessee may say borrow say rupees 80 and then add interest of rupees 20 with the result that it needs to repay rupees 100, right? Or there is another way. The assessee may issue a zero coupon bond. The assessee may issue a zero coupon bond. And zero coupon bond basically is a bond and it is notified under the Income Tax Act and it is issued by specific entities. But the feature is that no payment or benefit is receivable before maturity or redemption. So that means an assessee may, for example, issue zero coupon bond at rupees 80 and on redemption pay rupees 100, right? And no payment or benefit is payable or receivable in the interim. Now this 20 rupees difference is what we call as the discount on zero coupon bond. And this is amortized. And this is amortized across the period of life of such bond, right? So we compute the pro rata amount of discount, right? And then we amortize it across the period of life of such bond. And the method is prescribed under Rule 8C. Since this is not very much relevant from an exam perspective, we are not going to discuss the provisions of Rule 8C, which are basically prescribed under these steps, which you can see in this table. So we will now straight away move to the next theme in this video, which is deduction on account of employee welfare expenditure. Now in respect of employee welfare, we will look at contribution to employee welfare funds, health insurance premium, bonus and commission. First, we look at contribution to employee welfare funds. What are the tax implications? So as you can see, there are several provisions which are involved, which are applicable. But I've combined all these provisions and I have created the analysis which will give you a clear and a very good idea of what are the tax implications in this respect. So let's proceed ahead. Now the Act allows for deduction in respect of sums which are paid by the assessee as contribution to employee welfare funds. And we know these funds can be provident fund, superannuation fund, gratuity fund, etc. The fund may be approved or recognized. The fund may be unapproved or unrecognized. The contribution may be paid by the employer himself, which is called the employer's contribution, The contribution may also be employee's contribution, which is received by the employer from the employees and which he is supposed to deposit in the fund on behalf of the employee. So employer's contribution as well as the employee's contribution, which is received by the employer, right? Now, deduction is subject to compliance with section 43B in respect of employer's contribution. So 43B doesn't apply in respect of employee's contribution, but in respect of employer's contribution. Now let's see the tax implications. So first we look at a recognized provident fund or an approved superannuation fund, RPF or ASF. Now what about sum which is paid by the SSE as employer's contribution? Employer's contribution is deductible, section 36(1)(4), and this is subject to compliance with 43B. If 43B is not complied with, the SSE is not allowed deduction in respect of his contribution. That is the employer's contribution. What about employee's contribution? So employee's contribution is what the employer receives, right? So the employer receives contribution from the employees, which is their own contribution, and then the employer is then supposed to deposit such money, such sum in the relevant fund on behalf of the employees, right? So the money from employees to the fund is routed through the employer. So what is the tax treatment? The tax treatment is that the sum which is received by the SSE from his employees as their contribution to the fund is first included in the income of the SSE, because it is the sum which is received by the SSE. So it is first included in the income, and thereafter in the second step a deduction is allowed, section 36(1) VA, if such sum is credited to the employee's account in the fund, right? If the employer credits such sum which he has received from the employees to their account in the relevant fund, then he is allowed a deduction, else he is not allowed a deduction, and there is a time limit. Such sum should be credited by the employer in the fund on or before the due date. Which due date? Not the due date of filing return of income as under the Income Tax Act, but the due date of the relevant fund. That is the date by which the employer is required to credit the amount to the employee's account as per rules of the fund. For instance, the due date under the EPF scheme is 15 days from the close of every month. So for instance, if the employer receives 1 lakh from the employees as their contribution in the month of March, then by 15th April, the employer should credit the amount to the employee's account in the EPF. If say he credits the amount of 1 lakh by say 15th of April, then 1 lakh is allowed. So 1 lakh is first treated as income of the employer, and then the employer is allowed deduction of 1 lakh rupees. But if instead of 15th April, the credit in the fund is made on say 15th of May, so it is beyond the due date. In such case, 1 lakh it's treated as the income of the employer, but the employer is not allowed a deduction of 1 lakh, with the result that 1 lakh gets taxed in the hands of the employer. Okay, so this is the tax treatment in respect of employees' contribution which the SSE receives. Now, approved gratuity fund. Employer's contribution to approved gratuity fund is deductible, 36(1)(v), and this is subject to 43B. But provision for gratuity is not deductible. Provision for gratuity is not deductible. Now, we'll see this in some detail. So as we noted above, contribution of employee to the approved gratuity fund is deductible. But provision which is made by the SSE for the payment of gratuity to his employees is not deductible. Provision made for payment of gratuity to the employees is not deductible. But provision for payment of gratuity that has become payable during the previous year is deductible. It is allowed as deduction. So that means provision made for payment of gratuity which has not become payable during the previous year is not allowed as deduction. Okay, so provision for payment of gratuity that has become payable during the previous year is allowed as deduction, section 40A(7). Okay, payment for contribution to approved gratuity fund is what we have already discussed. It is allowed as deduction, 36(1)(v) subject to 43B, right? Now, provision which is made for payment of contribution To approved gratuity fund subject to 43B, compliance is also allowed as deduction. So provision made for payment by way of contribution to approved gratuity fund is also allowed as deduction 40A7. Finally, actual payment of gratuity, if it is made during the previous year, it also falls within section 37(1) and it is also allowed as deduction. So A, B, C, D. So that means the deduction is allowed for these items A, B, C or D. But multiple deductions of the same amount cannot be allowed. So deduction is allowed for either of the following. So as far as gratuity fund is concerned, deduction is allowed on two counts. Either the assessee makes a provision for payment of contribution to approved gratuity fund, or the assessee makes payment of contribution to approved gratuity fund. Both are allowed. Now, as far as payment is concerned, it is allowed on two counts. Either the assessee makes a provision for payment of gratuity, but only that gratuity which has become payable during the previous year, it is allowed as deduction. Or the assessee makes actual payment of gratuity during the previous year, it is also allowed as a deduction. But since deduction is allowed for either of the following, multiple deductions are not allowed for the same amount. So, for example, if the assessee has been allowed deduction in respect of provision for payment of contribution to approved gratuity fund, then when the actual payment of contribution is made to the approved gratuity fund, deduction will not be allowed because deduction has already been allowed by way of a provision. Similarly, when deduction has been allowed in respect of provision made for payment of gratuity that has become payable during the previous year, it will not be allowed deduction once again under section 37(1) when the payment of gratuity is actually made during the previous year. Therefore, double deduction in respect of provision for payment as well as payment is not allowed. Is this clear? So there are four counts A, B, C, D in respect of which the deduction is allowed, but multiple deduction or a double deduction obviously cannot be allowed. Now, receipt by the assessee from employees as their contribution is not relevant in the case of approved gratuity fund. What about National Pension Scheme, NPS? Both employer and employee contribute. As far as employee's contribution is concerned, it is deductible, 36(1) iiia. 36(1) iiia, and this is again subject to 43B compliance. But the deduction has a cap, it has a limit. So this amount, the sum of employee's contribution to NPS account of the employee is deductible up to 10% of salary of the employee in the previous year. Up to 10% of salary. Beyond this amount, even if the employer makes a contribution, he will not be allowed as a deduction. So up to 10%, that is the maximum limit. And what is the salary for this purpose? It is basic salary plus DAT, that means DNS allowance, if the terms of employment so provide. That means if the DNS allowance is considered as part of salary for computing retirement benefits. CTO, commission based on fixed percentage of turnover. So this is the salary, right? SSE doesn't receive sum by the employees, so this particular point is not relevant in the context of NPS, but the employees can claim deduction under section 80 CCD in respect of their contribution to NPS. So this was 3. 4. If there is any other fund for employee welfare which is required by or under any law, then employer's contribution is deductible 40A9, and this is again subject to compliance with 43B. What about employee's contribution which the SSE receives, right? So the same treatment as that for RPF and ASF, that it is first included as income of the SSE and thereafter deduction is allowed if the employer deposits the sum in the account of the employee in the relevant fund on or before the due date as per the fund. Same treatment as that for RPF, ASF. Now what about provident fund or superannuation fund which is unrecognized or unapproved, or maybe any other fund which is not required by or under any law? Employee's contribution is not allowed as a deduction. What about employee's contribution received by the employer by the SSE? Same treatment. It is first included as income and thereafter a deduction is allowed, 36(1)(VA). Unapproved gratuity fund. Unapproved gratuity fund, employee's contribution not deductible and provision for gratuity is also not deductible. Employee's contribution received by the SSE, it's not relevant in the case of unapproved gratuity fund. So this is the tax treatment in respect of employee welfare funds. What about health insurance premium? Health insurance premium paid by the SSE as an employer for his employees is allowed as deduction, section 36(1) IB. But the condition is payment should not be made in cash. If the payment of health insurance premium by the employer has been made in cash, then deduction is not allowed to the employer. Bonus and commission, this is covered by section 36(1)(2)(I). So bonus or commission which is paid to an employee for services rendered is allowed as deduction to the employer, and this is subject to compliance with section 43B. But there is a condition that such sum which is paid as bonus or commission, it should not have been payable to the employee as profits or dividend if it had not been paid as bonus or commission, right? That means if the bonus or commission was not paid, it should not have been paid to the employee as profits or dividend. If this condition is fulfilled, then bonus or commission which is paid to the employee is allowed as deduction subject to 43B compliance. So this was about the theme as far as deductions on employee welfare is concerned, and now we move to the next theme, which is deduction on account of taxes. So first we will look at securities transaction tax STT or commodities transaction tax CTT. STT is covered by 36(1) XV and CTT is covered by 36(1) XVI. Now, as we would know, securities transaction tax is a tax which is levied on purchase of sale of securities, say shares, securities, units, etc. Right? And commodities transaction tax, it is levied on taxable commodities transactions, being sale of commodity derivatives and options. So when, say, the SSE sells shares or units or other securities or commodities, then the SSE will pay STT or CTT, and this will be in the nature of an expenditure from the point of view of the SSE. The question is whether STT and CTT will be allowed as deduction in the hands of the SSE or not, right? Now, two situations can arise. For example, if, say, the shares are held as capital asset, and such shares are sold and STT is paid. So, income which arises on account of such sale, will it be taxable under the head PGBP or capital gain? Since it is a capital asset, it will be capital gain, and therefore PGBP head will not come into play, and consequently this provision won't apply in such case, right? In a situation where, say, the shares are not held as a capital asset but as a stock in trade, then in such case the income from the sale of the shares and securities will be taxable under the head PGBP, and in such case the STT which the SSE would pay will be allowed as a deduction. Similar is the position in respect of CTT as well. So STT and CTT paid by the SSE is allowed as a deduction, but when there is a condition: if the income arising from the taxable securities or commodities transaction entered into the course of his business during the previous year is included in the income computed under the head PGBP. So if the shares, securities, commodities, units, etc. are held as a stock in trade, only then income will be included under the head PGBP, right? Because those transactions would then be entered into by the SSE in the course of his business during the previous year. And in such case, STT or CTT will be allowed as deduction. Otherwise, it will not be allowed as deduction. So for deduction, the shares, units, commodities, etc. should be held as stock in trade. Now, what about income tax? Section 48(2)(I) says that income tax is disallowed. Income tax paid is not allowed as a deduction. Now, this not only includes the income tax, but it also includes surcharge, cess, the HEC at the rate of 4%, or interest, fine, penalty, and fee under the Income Tax Act. All these amounts are disallowed. They are not allowed as deduction. What about refund of income tax? If income tax is disallowed, the refund of income tax is also not an income chargeable to tax. So income tax payment is disallowed and refund of income tax is not taxable. But what about interest on delayed refund of income tax? If there is a delayed refund of income tax, SSE is paid interest. Now that interest which is received, it is taxable, it is not exempt, it is taxable, but under which head? Not under the head PGBP, right? It is taxable under the head IFOS. So this was about income tax. What about other taxes like indirect tax, GST, excise, customs duty, or say municipal tax, or say professional tax, etc. What about these other taxes? Now they are allowed deduction. They are allowed deduction under which section? Under the general deduction section of 37(1). But this is subject to compliance with section 43B. If 43B is complied, then only deduction is allowed in respect of these taxes. Now, as far as penalty under these laws is concerned, it can either be for breach of law, in which case it is categorized as penal in nature, or it can be compensatory in nature. If the penalty is for breach of law and therefore it is penal in nature, it is not allowed. It is not allowed. But where the penalty is compensatory in nature, then it is allowed. Mostly the penalty are for breach of law and they are penal in nature and they are mostly not allowed. But depending on the facts of the case, if you figure out that the penalty is not penal in nature but it is compensatory in nature, then deduction can be allowed for that penalty. For example, in the case of GST, there are several situations where a penalty is leviable. So, for example, if the penalty is leviable for obstructing or preventing any GST officer in discharging his duties under the Act, then penalty is leviable under section 122 of the GST law, of the CGST Act. Now that is for breach of law and that is not compensatory in nature, that is penal in nature, and consequently it will not be allowed as a deduction. But in certain laws, the penalty may be compensatory in nature. For example, the tax is supposed to be paid by a due date, and if it is not paid, interest may be leviable and also compensatory penalty may be levied. Compensatory means to compensate for the loss of revenue to the government. If that be the case, then that particular compensatory penalty will be allowed as deduction. Now, tax on non-monetary perquisites, and the relevant provision is section 40AV. Now, when we were discussing in the video on salaries, we saw that if a payment is the obligation of the employee, for example, payment of tax, it is the obligation of the employee to pay income tax on his income, right? But if the employer discharges that obligation on behalf of the employee, that becomes a perquisite, and that is then taxable as salary in the hands of the employee. So therefore, there may be a situation where the employer says that, look, I will pay your income tax on your behalf. In that case, that payment of tax by the employer will become perquisite in the hands of the employee, taxable under the head salaries. But as we noted, there is an exemption which is given in this respect under section 1010cc, right? In respect of what? So the employer may say that I will pay the tax on your behalf in respect of non-monetary perquisites. In such case, the payment of such tax is not considered as perquisite in the hands of the employee and it is exempt by virtue of section 1010cc. Since it is exempt in the hands of the employee, here it is provided under 40AV that such tax which has been paid by the employer will be disallowed. It will not be allowed as a deduction, because it can't be the situation that you are allowing an amount as deduction in the hands of the employer and also exempting it in the hands of the employee, right? So any tax actually paid by the employer on non-monetary perquisite on behalf of the employee is disallowed. It is not allowed as deduction, section 40AV. Now we come to certain special deductions. Now we will look at certain special deductions and we will cover bad debts, remuneration and interest to a partner of the firm, and conversion of inventory into capital asset. Bad debts first. Deduction is allowed in terms of section 36(1)(7) and 36(2). And then tax treatment is also prescribed where the bad debt is subsequently recovered, and this is covered by section 41(4). And now we look at this chart. Provision for bad and doubtful debts. If provision for bad and doubtful debts is made in the accounts of the SSE, then no deduction is allowed. This is not deductible. Where the bad debt maybe the whole of it or any part of it, is written off as irrecoverable in the books of the accounts of the SSE for the previous year, then only it is allowed as deduction. If it is not written off as irrecoverable in the books, then deduction is not allowed. Now, when the bad debt is written off as irrecoverable in the books, two situations can arise. Two situations can arise. The general situation is where the debt has been taken into account in computing the income of the SSE. For example, sales. So, if the SSE has made a sale on credit, the sale will be included in the income of the SSE. So, that amount will be taken into account in computing the income of the SSE. It is a debt, it is an amount which the SSE is supposed to recover, right? And this becomes a bad debt. And it is written off as irrecoverable in the books of the accounts of the SSE. So, that amount of debt is then allowed as a deduction, right? So, this is a situation where the debt had been taken into account in computing the income of the SSE. In the second situation, the debt has not been taken into account in computing the income of the SSE. For example, the SSE gave a loan to someone. Now, when the loan is given, it will not be treated as income of the SSE. So, it is not taken into account in computing the income of the SSE. Now, when the loan goes bad, it becomes irrecoverable. Even if it is written off as irrecoverable in the books of the accounts of the SSE, it has become bad debt. Since it has not been taken into account in computing the income, it will not be allowed as deduction. It will not be allowed as deduction. Why? Because it was not taxed in the first place, and therefore it will not be allowed as a deduction. But there is an exception, and this is the only exception. In the case of banking business or money lending business, deduction is allowed. So what does the provision say? Where the debt represents money lent in the ordinary course of the business of banking or money lending which is carried on by the SSE, deduction of such debt is allowed. So if say there is a bank which gives a loan and that is the business of the SSE and the loan is given in the ordinary course of the business, it is money lent. Now if the loan is not recovered and it is written off in the books, it is allowed as deduction in the hands of the bank. Similar is the case for a money lender. But in all other cases, disallowance is made, it is not allowed as deduction. So is it required or is it necessary to prove or establish that the debt has actually become bad? Only then will the deduction be allowed? It is not necessary to prove or establish that the debt has become bad. What is required is only that the debt which the SSE thinks has become bad should be written off as irrecoverable in the books. It is not required for him to prove or establish that the debt has become bad debt. Now, provisions of ICDS are not relevant to the CA intermediate syllabus, but just to briefly pick up a point, as per the provisions of ICDS in certain cases, the income may be recognized even without recording the same in the accounts. Right? And this is one of the conditions for deduction of bad debts, that the debt should have been taken into account in computing the income. So that may be done as per ICDS without recording the same in the accounts. Now, later on, in case of a bad debt as per ICDS, right, that amount may be required to be written off as irrecoverable as per the provisions of ICDS. But since the amount was not recorded in the accounts in the first place, it will not be written off as irrecoverable in the accounts. And the condition for allowing deduction for bad debt was that the bad debt should be written off as irrecoverable in the books of account. So where this whole thing is done under ICDS, the question is what will happen, whether the SSE will be allowed as deduction on account of bad debt under this provision, because earlier the income was recognized and therefore it was brought to tax. So the provision says that in such case it shall be deemed that such debt has been written off as irrecoverable in the accounts for the purpose of deduction, and consequently deduction will be allowed under section 36(1)(7). Now after the debt has been allowed as deduction on account of being a bad debt, it may be subsequently or ultimately be recovered, right? So there is a debt which has become bad debt and deduction has been allowed under this provision, and subsequently some amount is, or the whole of the amount is, ultimately or subsequently recovered. Now what is the tax treatment in this respect? There are two steps. In the first step, we calculate the difference. We calculate what we call as the difference. And what is the difference? Amount of debt minus the amount deducted under section 36(1) BII. So if the amount of debt was 1000 debt and deduction which was allowed on account of bad debt was say 400. So the difference is rupees 600, right? That means what you can say is that 600 is the amount that we expect to receive, that we still expect to receive. 400 has been written off and it has been claimed as deduction. Now, we receive some amount. If the amount ultimately recovered is less than the difference, so out of this 600, say we receive only, ultimately we receive only 500. So that means 100 becomes a net loss. So that becomes the deficiency. And this deficiency is then deductible in the previous year in which the ultimate recovery is made. So in the year in which rupees 500 is recovered, this 100 of deficiency will be deductible by virtue of section 36(2). But in the other case, if the amount subsequently recovered is more than the difference, so instead of 600, we actually received say 700, right? So the difference, that is the excess, that is rupees 100. This 100 actually is out of this 400 which was allowed as a deduction earlier. So now since a deduction had been allowed, now it should be brought to tax. So the excess of 100 will be taxable as deemed business income of the previous year in which it is recovered. And this is section 41(4). Now under section 41(4), the excess becomes taxable whether the business or profession in respect of which the deduction was allowed is in existence in that year or not. So even if the business or profession in respect of which the deduction was allowed on account of bad debt ceases to exist in the year of ultimate recovery, even then this 100 rupees, which is the excess, it will be taxed under section 41(4) in that year. So this is the provision on account of bad debt. We now look at deduction on account of remuneration and interest to partner of a firm, and this includes LLP as well. The relevant provision is section 40B. So deduction is allowed to the firm in respect of what? In respect of remuneration to working partner. Remuneration to working partner, 1. And 2, on account of interest. And there is a limit. There is a limit up to which deduction is allowed, right? And the limit depends on the quantum of book profit. How is the limit computed? On the first 3 lakh of book profit, or if there is a loss, the limit is higher of 1.5 lakh or 90% of book profit. Okay, so if the book profit is actually a loss, then the limit is 1.5 lakh. If say the book profit is a total of 3 lakh, then the limit is higher of 1.5 lakh or 90% of 3 lakh, which is 2.7 lakh. So it is 2.7 lakh. If say the book profit is 5 lakh, then on the first 3 lakh of book profit, it is higher of 1.5 lakh or 90% of book profit. That means 2.7 lakh. And on the balance of book profit at the rate of 60%. That means balance of 2 lakh at the rate of 60%, 1.2 lakh. So total cap of deduction is 3.9 lakh. 3.9 lakh. So if for example, if 4 lakh of remuneration is claimed by the firm, only 3.9 lakh will be allowed as a deduction and 10,000 will be disallowed. Now this is the overall limit for payment of remuneration to all the partners during the previous year. So this limit that we calculate becomes the overall limit of deduction for the firm as a whole. As far as interest is concerned, it is allowed as deduction only up to 12% simple interest per annum. So anything excess is not allowed. So if the interest is at the rate of 15%, then only up to 12% is deductible. The excess of 3% is disallowed. Now there are 2 conditions that need to be satisfied for the allowance of deduction. First is that the remuneration or interest should be authorized by the partnership deed and it should be as per the terms of the deed. Second, the remuneration and interest, the payment, it should not be retrospective, it should be prospective. It should not relate to any period falling prior to the date of the partnership deed, right? So even if the partnership deed authorizes the payment with retrospective effect, that retrospective payment will not be allowed as a deduction. Only it will be allowed with prospective basis. Now, when we talk about deduction of remuneration, what all is included within the scope of remuneration? So this limit applies to what? This limit applies to salary, bonus, commission, or remuneration by whatever name called, right? So this is what we call as remuneration. And as we saw earlier, the deduction of remuneration to a working partner is allowed. So working partner means whom? It means an individual who is actively engaged in conducting the affairs of the business or profession of the firm of which he is a partner. Now, as we noted above, the limit of deduction for remuneration depends on the quantum of book profit. And book profit is equal to what? So we compute net profit as shown in the P&L account for the relevant previous year, computed as per PGBP provisions of the Act. And to that we add the aggregate amount of remuneration to all the partners if that has been deducted while computing the net profit. Okay, so net profit would have been arrived after deducting remuneration. We add back the amount of remuneration. In other words, book profit is equal to what? Book profit, in other words, is equal to income under the head PGBP before deducting remuneration to partners, right? So we add back the remuneration and that becomes the book profit, and then we determine the limit in terms of deduction for remuneration. Then we deduct the remuneration in terms of that limit, which means as allowed under section 40B, and that becomes the income taxable under the head PGBP. So book profit is arrived at before deducting remuneration but not interest. So book profit is arrived at after deducting interest to the partners. But that deduction of interest will be, of course, it will be as per the limit under section 40B, that is up to 12% interest, right? Remuneration to non-working partners, that is a sleeping partner, is not allowed as a deduction. But interest is allowed as a deduction whether it is to a working partner or to a non-working partner. Now this is how the remuneration and interest is allowed in the hands of the firm. Now when we talk about taxation in the hands of the partner, what is allowed as deduction to the firm is taxable in the hands of the partner. Consequently, what is disallowed in the hands of the firm is not taxable in the hands of the partner. So to the extent interest and remuneration is deductible in the hands of the firm under section 40B, it becomes taxable in the hands of the partner. And as we have noted earlier, this is taxable in the hands of the partner under the head PGBP, not under the head salary. And the relevant section is 28V. It is taxable in the hands of the partner as PGBP income or not as salary income. Similarly, the extent to which interest and remuneration is disallowed in the hands of the firm under 40B, it is also not taxable in the hands of the partner. So this was about remuneration and interest. What about share of partner in the total income of the firm? It is not covered by 40B. But as we know, share of partner which is received from the firm is exempt in his hands under section 10(2)(a). This is something that we have already discussed in the video on exempt income. Now there can be instances where inventory has been converted by the SSE into his capital asset. And such capital asset may be used in his business or profession. So what is the tax treatment in that case? Where inventory is converted into the capital asset or it is treated as a capital asset. For example, a computer dealer. Computer is a stock in trade. And now say he converts one computer as his capital asset. So business income will arise, 28 VIA. Business income will arise taxable under the head PGBP, and that will be equal to the fair market value of that computer, of the inventory on the date of conversion. right? So business income will arise. Now, if the computer is used for the purpose of business or profession, the SSE would like to claim depreciation. Depreciation will be allowed. So it will be included in the block actual cost. What will be the actual cost? The actual cost will be this fair market value. This fair market value, which was treated as business income, this will be the actual cost for the purpose. Now, if this inventory which is converted into capital asset is later on transferred, say now the computer is sold or it is transferred subsequently, then what will happen? Capital gain will arise. And what will be the treatment of this capital gain? We will see in the video on capital gain. So far in this video, we have looked at various sections 30 to 36, which provide for various deductions, right? And each of those sections allow deduction in respect of a specified expenditure. But there are several instances of expenditure which are not governed by any of those specific sections 30 to 36. And therefore, there is a need for a provision which allows for a general deduction. So section 37(1) is the section. Section 37(1) is the section which provides a general deduction and governs all such expenditure which is otherwise not covered under the specific deduction provisions which we have discussed in this video so far. So, section 37 allows deduction of any expenditure. It can be any expenditure, but deduction is allowed only if all the following conditions are satisfied. All the following conditions are satisfied, and there are 5 conditions to be satisfied. Number 1, the expenditure should not be of the nature described in sections 30 to 36. So the specific deductions which are provided in sections 30 to 36, the expenditure covered in those sections is governed only by those sections. So if an expenditure, for example, scientific research expenditure is covered under section 35, if it is allowed as per section 35, it is allowed as deduction. If it is not allowed as per section 35, then it cannot be allowed under section 37(1). So it should not be of the nature as described in sections 30 to 36. Number 2, it should not be in the nature of capital expenditure. That means only expenditure which is revenue in nature is covered under 37(1). Third, it should not be personal expense of the SSE. Otherwise, it will not be allowed as deduction. Number 4, it should be laid out or expended wholly and exclusively for the purposes of business or profession. So if it is not wholly and exclusively for business or profession, it will not be allowed as a deduction. And lastly, it should not be incurred for any purpose which is an offense or which is prohibited by law. So if the expenditure is an offense, for example, a bribe, it will not be allowed as a deduction. Or if it is prohibited by law, it will not be allowed as a deduction. And this particular point regarding expenditure which is an offense or which is prohibited by law includes 3 kinds of expenditure also. A, expenditure for any purpose which is an offense under any law or which is prohibited by any law for the time being in force, and that law can be a law in India or outside India. So whether it is an Indian law or it is a foreign law, it doesn't matter. The expenditure will not be allowed. B, if the expenditure has been incurred by an SSE, whereby the SSE provides any benefit or perquisite, and benefit or perquisite can be in whatever form. So any benefit or perquisite is provided to a person, and that person may or may not be carrying on a business or a profession, it doesn't matter. But if the person to whom the benefit or perquisite is provided and who accepts such benefit or perquisite, that acceptance by such person is in violation of any law or rule or regulation or guideline governing the conduct of such person, right? Then the expenditure incurred by the SSE is not allowed as a deduction. That means the SSE incurs an expenditure which results in a benefit or perquisite which is provided to a person, and the acceptance by that person of such benefit or perquisite is in violation of some law, rule, regulation or guideline governing the conduct of such person. So we are not talking about that person, we are talking about the SSE. The expenditure is then not allowed as deduction in the hands of such SSE. C, compounding fees which is paid. So expenditure to compound an offense under any law for the time being in force, and such law can be either in India or outside India. So Indian law as well as a foreign law, compounding fees which is paid by an SSE is not allowed as a deduction. Compounding fees, so certain offenses are punishable, right? So for example, prosecution may be launched, but they are compoundable. So a compounding fees may be paid and then the prosecution is not launched. So there is this settlement or an agreement which is arrived at between both the parties upon payment of compounding fees. So that compounding fees is not allowed as a deduction. So basically 5 conditions need to be fulfilled. Now we will look at certain instances of expenditure which are deductible under section 37(1), and in all such cases you will note that all these conditions 1 to 5 are satisfied. And for ease of understanding, I have split the screen, where in the above part of the screen you can see conditions 1 to 5, and in the lower part of the screen we go through the instances. So key man insurance premium is allowed as a deduction, right? And here, if you recollect, in the earlier part of this video, we saw that the sum received under a key man insurance policy is taxable as business income. So while the insurance premium is deductible, but the sum received under such policy is taxable as business income. If the SSE incurs litigation expenses to defend business, it is allowed as deduction under section 37(1). Legal and compliance expenses like filing of returns, audit, etc. is allowed under section 37(1). Penalty which is compensatory in nature, and you will recollect our discussion in respect of deductions on taxes, that penalty which is penal in nature, which is in respect of breach of law, is not allowed as deduction, but which is compensatory in nature, it is allowed as deduction. Damages for failing to fulfill terms of a contract is allowable as a deduction. Expenditure on raising loan or borrowing, right? So we take a loan or we borrow money and then we incur expenses like brokerage, bank charges, drafting of loan agreement, etc. This is allowed as deduction under section 37(1). Now we noted in the case of interest deduction under 36(1)(3)(i) that while interest is allowed under that particular section, but related expenses are not covered under that section 36(1)(3)(i). Instead, they are allowed under section 37(1). Salary to employees is allowed as deduction, right? But you will also note the discussion in respect of the specific provisions regarding deductions for contribution to employee welfare funds. So that is a specific provision. 37(1) covers salary to employees. Professional tax is allowed as deduction. Interest, which is not covered under 36(1)(3)(i), is allowed as deduction here under section 37(1). So under section 36(1)(3)(i), as we discussed, what is allowed? Interest on capital borrowed, but there can be other kinds of interest as well. For example, interest on delayed payment of purchase price, right? It is not covered by 36(1)(3)(i). Interest on deferred payment for purchase of assets and other kinds of interest which are not covered under 36(1)(3)(i), they may be allowed under 37(1) if the conditions are fulfilled. Advertisement expenditure is allowed as deduction. The SSE usually incurs customary expenses sometimes on festivals like Diwali or Muhurat or New Year. So as per a CBDT instruction, these are also allowed as deduction under section 37(1). Similarly, the SSE may incur training expenses to gain skills which he may then use in his business or profession. That is also allowed as deduction. So these are some instances of the expenditure, but whenever in the question you find different items of expenditure, you need to see whether all the conditions 1 to 5 are satisfied or not. If all of them are satisfied, then 37(1) deduction can be allowed. But if one or more of the conditions are not satisfied, then deduction under section 37(1) cannot be allowed. So now we will look at instances of expenditure which are not deductible under section 37(1), since all the above conditions 1 to 5 are not satisfied. For example, reserve created against contingent liability, right? So SSE may create a contingent reserve or contingency reserve, right? It is not allowed as a deduction. Why? Because it is not an expenditure which can be said to have been incurred. Protection money, extortion money, hafta, bribes, etc., which the SSE may pay to say some official, for getting some work done. That is not allowed as a deduction. Why? Because it is incurred for a purpose which is an offense or is prohibited by law. So condition number 5 is not satisfied. Sometimes pharmaceutical companies may give or provide some freebies to doctors, medical practitioners, right? And this is a benefit or perquisite which is then provided, and the pharmaceutical companies incur expenditure. Now that is not allowed as a deduction. Why? Because acceptance of such benefit or perquisite by doctors or medical practitioners is in violation of regulations of Medical Council of India, and therefore it falls under uh, condition number 5, which is then not satisfied, which is item number 5b, where the benefit or perquisite is accepted by the other person and that acceptance is in violation of the law, rule, regulation or guideline governing the conduct of such person. So that is not allowed as a deduction in the hands of such pharmaceutical company. Similarly, if penalty and damages have been paid for infringement of law, that is not allowed as a deduction because it is for a purpose which is an offense or is prohibited by law. Condition number 5 is not satisfied. Now, as per section 135 of the Companies Act 2013, certain companies are required to incur CSR expenditure. CSR expenditure. Now, this is specifically not allowed as a deduction, right? So, any expenditure which is in the nature of CSR expenditure, it is not deemed to be an expenditure incurred by the assessee for the purposes of business or profession, and this is specifically provided by explanation 2 of section 37(1), and therefore it is specifically disallowed. Next is also a case of a specific disallowance, and this is under section 37(2)(b). If any expenditure is incurred on advertisement which is published by a political party, not by any other person, by a political party, that expenditure is disallowed. And that advertisement can be either in the souvenir, in a brochure, in a tract, in a pamphlet, or the like, which is published by a political party. So such expenditure is specifically disallowed under section 37(2)(b). What about expenses which have been incurred to acquire an asset and make it fit for use, and depreciation is allowable on that asset? So as we noted above in this video, in the discussion on depreciation and actual cost, that such expenditure is added to the actual cost of asset for the purpose of depreciation under section 32, and therefore it falls out of the purview of 37(1). It is not allowed as a general deduction under 37(1). Rather, depreciation can be claimed in respect of such expenditure. What about a business loss? A business loss, because it is not an expenditure per se. But you would recollect in the earlier part of the video when we discussed about the treatment of business loss, we said that it can be allowed on general principles if it is revenue in nature and is incidental to business. For example, loss of stock in trade in fire, right? So business loss is not allowed under section 37(1), but it is allowed in terms of the general principles. What about expenditure which is specifically described under section 30 to 36? Section 37(1) is not applicable in such case because condition number 1 is not satisfied in such case. Then there could be an instance of expenditure which is not incurred during the previous year. If the expenditure is not incurred, it will not be allowed as deduction. For example, if the assessee follows cash system of accounting and the expenditure has become due, but it has not been paid during the previous year, so it is not incurred during the previous year as per the method of accounting followed by the assessee, so it will not be allowed as a deduction under section 37(1). There may be an expenditure which though it is incurred, but it is not incurred in the current previous year, in some other previous year, so it will again not be allowed in the current previous year because it does not pertain to the current previous year. Now the assessee may also appropriate profits by way of payment of dividend or transfer to reserve, payment of income tax, etc. This is not allowed as a deduction. Income tax, of course, is disallowed, but even payment of dividend, transfer to reserve, etc., it is not an expenditure to earn profits. It is an appropriation of profits. So appropriation of profits are not allowed as deduction by section 37(1). Then we have expenditure which is disallowed under any specific provision, right? And we are talking about section 30 to 36. So if say under section 30 to 36, if there is say interest on borrowed capital and it is supposed to be allowed as deduction under section 36(1)(3)(i), but subject to compliance with 43B. If 43B is not complied, 36(1)(3)(i) deduction for that interest cannot be allowed. So you cannot come to section 37(1) and claim deduction under section 37(1). So with this, we complete our discussion in respect of the deductions which are allowed while computing income under the head PGBP. We will now look at expenses which are not deductible in certain circumstances. And we will look at payments on which TDS is not deducted or paid, related party transactions, payment by non-specified mode, which is in excess of 10,000 rupees, and deduction which is allowed only on actual payment. So first we look at payments on which tax is not deducted or paid. And this is covered by three provisions, 40A(i), iiia and 3i. Now under the Act, tax is required to be deducted at source in respect of certain payments. So the payer is supposed to deduct TDS on behalf of the payee and pay that tax to the government, right? These provisions provide for disallowance of expenditure if TDS has not been deducted or paid, but the disallowance is not of a permanent nature. So when the tax is paid, disallowance is rolled back or reversed. There are three provisions which deal with three different categories of payments, and it is important to note which kind of expenditure pertains to which provision. So 40A(i) covers what? It covers payment which is either made outside India to any person, or if it is made in India, it is made either to a foreign company or a non-company which is a non-resident. So if the payee is a company, it should be a foreign company. If the payee is not a company, it should be a non-resident. If the payment is outside India, it can be to any person. And the payment should be of interest, royalty, FTS or other sum chargeable under the Act, but not salary. Not salary. Why? Because salary comes under section 40A(3)(i). 40A(3)(i) covers what? Any payment chargeable under the head salaries. If it is either payable outside India, or if it is payable in India, then it is payable to a non-resident, right? In such case, 40A(3)(i) applies. Then we have section 40A(iia). 40A(iia) covers what? It covers most of the payments which are relevant and important to us from an exam point of view. And it covers any sum which is payable to a resident, right? So any sum which is payable to a resident during the previous year gets covered under 40A(iia), right? In all these cases, tax should be deductible at source from such payment, because if TDS provisions don't apply to such payment, these provisions don't become applicable. So there is no question of any disallowance under these provisions in the first place. So what we need to be clear is, first we need to accurately categorize the payment under either 40A(i) or 40A(iia) or 40A(3)(i). Then we come to the next point where we see when is the payment disallowed. When is the payment disallowed? Now first we look at 40A(i) and 40A(iia), right? The first two provisions, 40A(i) and 40A(iia). And there are two situations in which disallowance can be made. First, where tax has not been deducted in the previous year. So the assessee incurred an expenditure, made the payment, TDS was to be deducted, but TDS was not deducted in the previous year. Okay. So for instance, this is previous year 22-23. For example, previous year 22-23, and the payment is made on say 1st of March. Payment is made on 1st of March of say 1,000 rupees, and TDS was supposed to be deducted, but TDS is not deducted, and 1,000 rupees has been paid without deduction of TDS. So disallowance will be made. Disallowance will be made. And what will be the extent of disallowance? If it is 40AI, then 100% of the sum will be disallowed. That means 1000 will be disallowed and the amount of deduction allowed will be 0. If it is a case of 40IA, that means if the sum is paid to a resident, then 30% will be disallowed. That means out of 1000, 70%, which is 700, will be allowed as deduction, but 300, which is 30%, will be disallowed. Right? This is the first situation. The second situation could be that tax has been deducted in the previous year. But now the tax which is deducted also needs to be paid to the government. But the tax has not been paid to the government. And there is a timeline. Till when? The tax has not been paid till the due date to furnish return of income under section 139(1) for such previous year. So if in this case on 1st of March 1000 was paid after deducting TDS, so TDS was deducted. But for instance, if the date of furnishing return of income is 31st of July 2023 for previous year 22-23, right? And the TDS, while it was deducted on 1st March 2023, but TDS is say paid on 1st of August 2023. So it is after the due date of 31st of July. So disallowance will be attracted. 700 will be allowed as deduction, but 300 will be disallowed. If, however, the payment of TDS to the government is made, say, on 31st of July, right? So it is on or before the due date. In that case, no disallowance will be made and entire 1000 will be allowed as deduction in previous year 22-23. So what is the effect of this? No disallowance is made in the previous year in which expenditure is incurred. So no disallowance can be made in previous year 22-23 if either tax has been deducted and paid in that previous year. So tax, say on 1st March 2023, 1000 is paid, TDS is deducted, and the payment of TDS is also made, say on 15th March. So tax has been deducted and paid in previous year 22-23, no disallowance is made, 1000 will be allowed as deduction. Or where tax has been deducted in that previous year and paid by the due date to furnish return of that previous year. So on 1st March 2023, payment was made, TDS was deducted, and TDS has been paid on or before 31st of July 2023. In such case, 1000 will be allowed as deduction for previous year 22-23, no disallowance will be made. This was about section 40AI and 40IA. And what about section 40A3I? What about section 40A3I? Disallowance of the expenditure is made. That means 100% is disallowed if tax is not paid thereon nor deducted therefrom. So this is the position for 40A3I. Now we have understood when is the payment disallowed. When is the payment disallowed? Now, as we noted above, disallowance is not of a permanent nature. That means disallowance can be rolled back or can be reversed. When is this done? When is this done? Sum that was disallowed as above is subsequently allowed as a deduction. When? In the following situations, two situations. Where tax has been deducted in the subsequent previous year, or tax had been deducted in the relevant previous year but is paid after the due date to furnish return under section 139(1) of that previous year, in which case, in both these cases, deduction is allowed in the previous year. Which previous year? In which tax has been paid. In which tax has been paid. So in our example, the first situation, tax has been deducted in any subsequent previous year. Right? So for example, 1st March 2023, 1000 rupees is paid without deducting TDS. And tax is deducted in the subsequent previous year, for example. It is say deducted on say 1st of May. 1st of May 2023, that means subsequent previous year 23-24. In such case, deduction is allowed in the previous year in which tax has been paid. And if the tax has been paid to the government on 1st May 2023, right? In that case, deduction will be allowed. The disallowance will be rolled back in previous year 23-24. So what will happen? On 1st March 2023, 1000 was paid without deducting TDS. So 700 was allowed as deduction, 300 was disallowed. Now what about this 300? When will this be allowed as deduction? When will the disallowance be rolled back? If say the TDS is deducted and paid to the government on 1st May 2023, then that is now previous year 23-24. So that 300 which was disallowed, it will be allowed now as deduction. So disallowance will be rolled back in previous year 23-24. Second situation is that tax had been deducted in the relevant previous year but is paid after the due date to furnish return. So for example, 1000 is paid and TDS was deducted. But TDS is paid to the government after 31st of July 2023. Say here, it is paid on 31st of August 2023. So disallowance will be rolled back when? In the year in which tax has been paid. When? That is 31st August 2023, which is previous year 23-24. So disallowance would be made in 22-23. Out of 1000, 700 will be allowed as deduction, 300 will be disallowed, 300 will be allowed in the previous year 23-24 in which the tax has been paid. Now there is a situation where deduction is allowed even if tax has not been deducted. So as we saw above in 40AI and 40AIA, okay, the point that we missed is the provision for rollback of disallowance that we were discussing earlier doesn't apply in the case of 40A3I. It doesn't apply for 40A3I, only for 40AI and 40AIA. Okay, so now what we noted above is that disallowance is made in 40AI and 40AIA if tax has not been deducted in the previous year. But even in such case, deduction can be allowed if certain conditions are satisfied. So this is an exception. This is an exception. So even if the tax or any part thereof has not been deducted, so previous year 22-23, 1st March payment is made of 1000 rupees and TDS has not been deducted by the payer, he can still claim deduction. Without this provision, as we noted earlier, 700 will be allowed as deduction under 40AIA and 300 will be disallowed. We are talking say of 40AIA. But even when TDS has not been deducted, deduction can still be claimed if the payee, note, now these conditions apply to the payee to whom the payment has been made, not to the payer. If the payee fulfills three conditions. One, he has furnished his return under section 139. Say the due date for the payee is 31st of October and the payee first furnished the return under section 139 on or before the due date. Second, the payee has taken into account such sum for computing income in such return. So this 1000 rupees, which is the expenditure of the payer, it is included as income by the payee in his return of income. And the payee has paid the tax due on the income declared by him in such return. So effectively, in respect of this 1000, the payee has paid the tax, right? So what is happening? The payer has not deducted the tax, but the payee has now paid the tax on that particular component. And the further condition is that the payer, not the payee, the payer should furnish a certificate to this effect from an accountant, right? So the payer should furnish a certificate that these three conditions have been fulfilled by the payee. In such case, what will happen? The payer will be deemed to have deducted and paid the tax on such income. Even if he has not deducted the tax, he will be deemed to have deducted and paid the tax, and therefore disallowance will not be made. But on what date? He will be deemed to have deducted and paid the tax on such income on the date of furnishing of return by the payee, right? So this means that if the payee in our example furnished the return on 31st of October and fulfilled all these three conditions and the payer furnished a certificate to this effect, then what will happen? The sum will still be disallowed in the year of incurring expenditure. Out of 1000, the sum will still be disallowed, right? So 700 will be allowed while 300 will not be allowed. But it will be allowed in the year of furnishing of return by the payee, because the assessee will now be deemed to have deducted and paid the tax on such income. So this 300 will not be allowed in previous year 22-23, but it will be allowed in the year of furnishing of return by the payee, which is 2023-24. So in effect, the disallowance will effectively not be made in the hands of the SSE even if the SSE or the payer has not deducted TDS, right? Because the payee has fulfilled these conditions, though the allowance of that 30% will be made not in the year in which expenditure is incurred, but in the year in which the return is furnished by the payee, right? In our example, in the subsequent previous year. But this means that the disallowance will not be of a permanent nature. The SSE will be allowed a deduction. So what is the net effect? The net effect of the provision that we discussed: when is the payment disallowed, when is disallowance rolled back, and when is deduction still allowed even if tax has not been deducted. The net effect of the aforesaid provision 40AI and 40AIA is to allow deduction only when tax is paid. You will note that deduction is to be allowed only when the tax is paid either by the payer or by the payee. We now look at related party transactions. And the disallowance in this respect is governed by section 40A2. And this provision seeks to disallow any excessive or unreasonable payment made to a related party. So an SSE make a payment to a party which is a related party, and the payment which may be made may be excessive or unreasonable, and the SSE may be able to make such excessive payment or unreasonable payment because the party is a related party. So the SSE exercises an influence on such party. And why will the SSE do that? To claim a higher amount of expenditure as a deduction, right? So section 48(2) controls such excess or unreasonableness. Now there are two conditions. Disallowance is made if the following conditions are satisfied. Condition number 1. The SSE incurs any expenditure for which a payment has been made to any related party. Okay. And condition number 2. The assessing officer is of the opinion that such expenditure is either excessive or unreasonable. So if the payment is made to a related party and the AO feels that the expenditure is excessive or unreasonable, so to the extent the expenditure is considered excessive or unreasonable, it is disallowed under section 48(2). So the obvious question would be, what is a related party? There is a list of related parties which is given in section 48(2), but the list is complex and the entire list is not relevant from an exam point of view. Therefore, the concept of related party in relation to individual SSE alone is something that we will discuss and which is important from an exam point of view. So related party basically means in the context of our exams, either one or two. Either one or two. One, related party is any relative of the SSE. Any relative of the SSE. Who is a relative? Relative is the spouse, brother, sister, or any lineal ascendant or descendant of the SSE. And you can use the acronym SBSLAD for ease of learning, right? So if this is the SSE and he makes payment to his spouse of 1 lakh as expenditure for say services rendered by the spouse, but the reasonable payment which should be made is say only rupees 70,000. So that means 30,000 is unreasonable. So payment is made to a related party because the spouse is a relative of the SSE. So only rupees 70,000 will be allowed as deduction. 30,000 will be disallowed. So related party means 1. Any relative of the SSE. 2. It means any person who carries on a business or profession where the SSE or any relative of the SSE has a substantial interest in the business or profession of that person. In the business or profession of that person. Okay. And what is substantial interest? Where the person is the beneficial owner of at least 20% equity shares, if it is a case of a company, or is beneficially entitled to at least 20% of business profits in the case of a non-company at any time during the previous year. At any time during the previous year. So here is the SSE, okay, and he makes payment to a company which is C Limited, in which the SSE is holding 50% equity shares. So SSE is holding substantial interest in C Limited, right? So C Limited becomes a related party because SSE has a substantial interest in the business of C Limited. And if the SSE makes payment of 1 lakh to C Limited, but for which the reasonable amount is only 70,000, then the excess of 30,000 will be disallowed. This will also be the case where, say, the spouse of the SSE holds 50% equity shares in C Limited. So the spouse has a substantial interest in C Limited, right? And the spouse is the relative of the SSE. So relative of the SSE holds substantial interest in C Limited, and SSE is making payment of 1 lakh, right? Which is excessive. So in that case also, the excess of 30,000 in our example will be disallowed. So what we see is either a relative of the SSE or any person where the SSE or relative of the SSE has a substantial interest in the business of that person, right? So this is the provision of section 40A(2). We will now look at the provision of disallowance in respect of payment by a non-specified mode which is more than rupees 10,000. Section 40A(3) ready with rule 6TD, right? So where there is any expenditure in respect of which a payment is made to a person in a day which is otherwise than by a specified mode, that is, it is by a non-specified mode and the amount exceeds rupees 10,000. The amount exceeds rupees 10,000. If it is a case of multiple payments to a person in a day, then the aggregate of the payments is considered, right? Then if that payment or the aggregate of the payments exceeds rupees 10,000, then that particular expenditure is disallowed. 100% of such expenditure is disallowed. So the expenditure may be any expenditure whatsoever, right? And a payment or aggregate of payments is made when? In a day. To whom? To a person. How? By a non-specified mode. Of what amount? Exceeding rupees 10,000. Then that amount is disallowed. It is not allowed as a deduction under section 40A(3). Where the payment is made for plying, hiring or leasing of goods carriages, this limit of rupees 10,000 is increased to rupees 35,000. So basically, payment to transporters carries a limit, a threshold, a higher limit of rupees 35,000 instead of the ordinary limit of rupees 10,000. Specified modes are account pay, check or demand draft, bank ECS, credit card, debit card, net banking, IMPS, UPI, RTGS, NEFT, Bhim Aadhaar Pay. You would recollect that this is the same provision which we discussed in the context of actual cost. If this condition is satisfied, the payment is not included in the actual cost for depreciation purpose. Also under 35AD, deduction is not allowed under section 35AD if the expenditure hits this condition. The specified modes are also the same as we looked at in the context of actual cost and section 35AD. So this provision provides for a disallowance. By disallowance, we mean that there is an expenditure that is required to be deducted, but it is not allowed to be deducted. That is called a disallowance. But there may be a situation where before the payment is made in this particular fashion, the expenditure has already been allowed as deduction. How will that be? The expenditure will be allowed as a deduction on due basis when the liability has been incurred by the SSE for any expenditure. So the deduction would have already been allowed. But in a subsequent previous year, when the payment is being made, then the payment is made in this particular fashion, which is held by section 40A(3). Now, this allowance, of course, cannot be made because the allowance of expenditure has already been made. So what will happen? Now, the amount of payment that is made, which is being hit by 40A(3), will become taxable. It will be deemed business income of such subsequent previous year in which payment is made, right? So if we are talking about the previous year in which the liability is incurred, and if the payment is also made which is hitting this provision, then disallowance will be made. But if the deduction has already been allowed in an earlier previous year, then instead of disallowance, deemed business income will become taxable in that subsequent previous year in which payment is made. So when the expenditure or when the payment is hit by this provision, then 100% of the expenditure is disallowed, not the expenditure which is exceeding rupees 10,000, right? So 40A3 basically applies to all kinds of expenditure which are deductible in computing business income. If the expenditure is not deductible in computing business income, there is no question of a disallowance in the first place. So expenditure should be deductible in computing business income, but if it is hit by 40A3, it will not be allowed as a deduction. So non-compliant payments, some examples could be payment in cash, payment by uncrossed check, cross check because it's not account pay, by a bearer check. All these kinds of payments are hit by section 40A3, right? Now, as we noted, 40A3, the similar provision is what we saw in the context of actual cost. Therefore, 40A3 does not apply. It does not apply in those particular circumstances. So where there is a payment for purchase of assets on which depreciation is allowable, 40A3 doesn't apply in that case. In that case, such expenditure doesn't form part of the actual cost, and consequently depreciation cannot be claimed in that particular aspect. Similarly, we noted 35AD as well. In that case also 40A3 is not relevant, because if deduction is to be claimed under 35AD and the expenditure is non-compliant, then it is not deductible under section 35AD, right? So for depreciation purpose and 35AD purpose, there are separate provisions which have been built into those provisions, and for all other kinds of business expenditure which are deductible in computing business income, 40A3 applies. So where, for example, a loan has been advanced, 40A3 won't apply, right? Why? Because it is not an expenditure which is deductible in computing business income. Or if the loan has been taken and the principal is to be repaid, right, then also 40A3 will not apply. But if interest is being paid, then 40A3 will apply, because interest will be deductible in computing business income. Now there are certain situations, there is a list of situations which is prescribed under Rule 60D, which provides exception to 40A3. That means disallowance under 40A3 is not supposed to be made even if the expenditure is non-compliant, right? There is a list which is prescribed under Rule 60D, but we will only look at some of the entries which are very important from an exam point of view. So if a payment is made to Reserve Bank of India or to any bank or to the government, then 40A3 is not hit. Then 40A3 doesn't apply and disallowance is not made. So this is an exception under Rule 6DD. Similarly, in the case of a book adjustment, where the payment is made by way of adjustment against the amount of any liability which is incurred by the payee for any goods supplied or services rendered by the SSE to such payee. So A is the SSE, okay, and say B is supposed to pay 50,000 to A, and say A is supposed to pay 40,000 to B, because both have rendered services or supplied goods, right? So A is supposed to pay 40,000 to B and B is supposed to pay 50,000 to A, and this 40,000 is squared off on account of a book adjustment, right? So this squaring off is not by way of a specified mode, but 40A3 won't apply because of the exception provided in Rule 6DD. Then we have a case of no bank area, right? So there may be a village or a town where there is no bank facility is absent, and the payment is made to a person who resides in such village or town, or who carries on a business or profession or a vocation in such village or town. Then in such case, Rule 6DD comes into play, and even if the payment is non-compliant, then 40A3 will not be hit. Now we will talk about section 43B, which deals with deduction only on actual payment. Section 43B links the deduction to the actual payment, right? Deduction is not allowed on due basis, but only on actual payment basis. The SSE cannot say that the liability for the expenditure has been incurred on due basis and therefore deduction should be allowed. So even if the deduction on due basis is allowable under the relevant provisions of the Act, it is hid by section 43B, and therefore section 43B suspends the deduction till the time actual payment is made. So we need to look at the sums which are hid by or which are covered by section 43B, and there are 7 such sums. And try to recollect the discussions that we have made in the video so far. You will be able to recollect the various provisions which are covered by these 7 items. These 7 items, right? And we have referred to section 43B compliance, where we have made discussions in respect of these items in the earlier part of this video. First is tax, duty, cess or fees by whatever name called under any law. For example, payment of GST. Second, contribution as an employer. That means employer's contribution to what? To provident fund, superannuation fund, gratuity fund or any other fund for the welfare of employees. So employer's contribution, mind you, not employee's contribution, employer's contribution to an employee welfare fund. Third, bonus or commission to an employee, which we have discussed in section 36(1)(ii). Fourth, interest. We have discussed the deduction under section 36(1)(3)(i), where we saw this particular sum is referred. Interest on any loan or borrowing from a PFI or SFC or SIIC or NBFC. Fifth, interest on any loan or advance taken from a scheduled bank or a cooperative bank other than a primary agricultural credit society or primary cooperative agricultural and rural development bank. So basically, in the terms of interest, what we are saying, basically interest on loan or advance from a bank or interest on loan or borrowing from PFI or SFC or SIIC or NBFC. Sixth, leave salary which is payable by an employer to an employee. And seventh, lastly, payment to the Indian Railways for the use of railway assets. So these 7 sums are covered by 43B and they are allowed as deduction only on payment basis. Now the deduction in respect of the aforesaid sums is allowed, as we can see in this particular chart, and there are 3 situations, right? In situation A, the sum is actually paid in the previous year in which the liability to pay such sum is incurred. Taking an example, the liability to pay such sum is incurred in previous year 22-23 and the sum is paid within this previous year, say on this date or this date or this date or any other date within the previous year 22-23. In that case, deduction is allowed in the previous year in which the liability to pay such sum is incurred. So since the actual payment has been made, deduction will be allowed in previous year 22-23 itself. There is no problem in this case. Now we come to situation B, where the sum is actually paid not within the previous year in which the liability is incurred, but on or before the due date for furnishing return of income under section 139(1) in respect of the previous year in which the liability to pay such sum is incurred. Taking our example, the liability to pay the sum is incurred in previous year 22-23 and the sum is say paid on or before 31st July 2023, assuming this is the due date of furnishing return of income. So if the sum is paid after the end of previous year 22-23, but maybe on this date or this date or this date or any date on or before 31st of July, then the same situation will apply and deduction will be allowed in the previous year in which the liability to pay such sum is incurred. That means the deduction will still be allowed in previous year 22-23. So that means for claiming deduction in previous year 22-23, the sum should be actually paid either within the same previous year or up to the due date to furnish return of income under section 139(1) for that previous year. In situation C, what happens is that the sum is actually paid after the due date for furnishing return of income referred in situation B. So that means in situation C, the payment is made after this particular date. So payment can be made any time after 31st of July. And if that be the case, then what is the year in which deduction is allowed? Deduction is allowed in the previous year in which such sum is actually paid. So if the actual payment happens at any time after 31st of July 2023 in our example, then if say the payment is made say on 1st of October 2023, then deduction will be allowed in the previous year 2023-24. If the payment happens on say 1st of October 2024, then deduction will be allowed in previous year 24-25. So this is the effect of section 43B. Now you would note that in situation B, where the sum is paid after the end of the previous year, but within the due date of furnishing return of income, there is an additional condition which is prescribed, and which is that the evidence of such payment of making the payment on or before the due date of return of income should be furnished by the SSE along with the return of income. Only then the deduction will be allowed, else it will not be allowed. And this additional condition is only applicable for situation B. It is not applicable for situation A and situation C. Now sometimes tax liability is payable next year, right? So sum is payable as tax, etc. Right? Number 1 of the table. Number 1 item where we were discussing the sum. Tax, duty, cess or fees by whatever name called under any law. So there could be a situation where the sum which is payable as tax, etc. the SSE has incurred liability in the previous year to pay such sum, even though the sum might not have been payable within that year under the relevant law. For example, let's take an example where GST collected for the month of March becomes payable in the next month, that is April, right? So the liability is incurred in the previous year, but the sum is not payable in March, sum becomes payable to the government in April. What happens in such case? In such case also 43B applies. So if the SSE makes a provision for GST as on 31st March, that provision will not be allowed as a deduction unless section 43B has been complied with, and that amount is paid in terms of this provision. That means latest by the due date to furnish return of income for that previous year. Sometimes what happens that in the case of interest, number 4 and 5 of the table, number 4 and 5, interest and interest, right? In this case, when we are talking about interest, sometimes instead of actually paying the interest, it may be converted into a loan or a borrowing or debenture or any other instrument. And the effect is that the liability to pay is deferred to a future date. So interest is converted into a loan once again, right? So the provision states that conversion of interest is not deemed to have been actually paid. Thus interest is not actually paid in this sense. Therefore it is not deductible, right? Section 43B cannot be said to have been complied with. One cannot say that it is a constructive payment of interest. Such converted interest is deductible only once it is actually paid. Now we have noted above that one of the sums is employer's contribution to provident fund, superannuation fund, etc., to which 43B applies. So the deduction in respect of employer's contribution is covered by section 43B. That means employer's contribution should be paid latest by the due date of furnishing return of income for that previous year, if deduction is to be allowed. But employee's contribution is different. We have noted in the discussion on this particular topic in this video that employee's contribution will be received by the SSE. It will first be included as his income, and then deduction will be provided if the employer deposits such sum to the account of the employee in the fund on or before the due date. But what is the due date for that purpose? It is not the due date of the return of income, right? It is the due date as per the relevant fund. So this is the difference. As far as employee's contribution is concerned, the payment needs to be made by the employer by the due date as per rules of the fund. But where employer's own contribution is concerned, then section 43B applies. Section 43B is not relevant when the SSE follows cash system of accounting. It is but obvious because expenditure is anyways deductible on payment basis. So this is the discussion on section 43B, and this brings us to the end of the theme on expenses which are not deductible in certain circumstances. We will now deal with certain special provisions, and we will look at the provisions governing recovery against deduction already allowed, sum received after discontinuance, full value of consideration for transfer of land or building. So first we look at recovery against deduction already allowed, which is governed by section 41(1). So this provision basically covers a situation where a deduction has been allowed and there is a subsequent recovery. So there is a benefit which has been obtained by the SSE, which is categorized as deemed profit and is brought to charge to tax. So what is the situation that is covered by section 41(1)? It covers a situation where an allowance or deduction has been made for any year in the hands of the SSE, and this is in respect of, say, a loss or expenditure or trading liability incurred by the SSE. Say GST has been paid and the SSE has claimed deduction on that account, for example. Now subsequently, during any previous year, the SSE has obtained any amount in respect of such loss or expenditure, right? So for example, in respect of that GST for which deduction was claimed, a refund has been obtained. So any amount has been obtained in respect of such loss or expenditure, or some benefit in respect of such trading liability, right? So in respect of loss or expenditure, any amount has been obtained. In respect of trading liability, there is a benefit which has been obtained. In what manner? So there may be a remission of trading liability, or the trading liability may cease. For example, goods were purchased on credit for say 1 lakh rupees and there is a defect, and therefore the creditor accepts rupees 20,000 in full and final settlement. So 80,000, which is the balance, it is actually a kind of remission. Now there's 1 lakh would have been allowed as a deduction, and 80,000 is the benefit which has been subsequently obtained. Similarly, for GST, deduction would have been claimed earlier and now there is a refund. So that is an amount which has been obtained. Now in both these cases, in our example, deemed profits arise under section 41(1). And what is the amount of deemed profit? The amount which is obtained, that means the GST refund in our example, or the value of benefit, that means the amount of remission of the trading liability of 80,000. That is the deemed profit, and it is taxable in the hands of the SSE as is income in the previous year in which the recovery is made, right? So allowance or deduction would be allowed in one previous year, and in a subsequent previous year the amount will be taxable under section 41(1), that is the year in which the recovery is made. There may be a situation where the business or profession in respect of which the allowance or deduction had been made is not in existence in the year of recovery. So will the amount not be taxed in the year of recovery under section 41(1)? 41(1) says that deemed profits will be taxable whether the business or profession in respect of which the allowance or deduction has been made is in existence in that year or not. It doesn't matter. Now, as we noted, there could be a remission or cessation of a liability, and 41(1) comes into effect in respect of that benefit which is obtained, right? So in our example, the creditor waived off the liability, right? But instead of a bilateral agreement between the two parties, there may be a unilateral remission or cessation of liability. For example, the SSE may himself unilaterally write off the liability in his accounts. That will also be considered as a benefit and it will be covered by this provision, and that amount, unilateral writing off of liability, will also be taxable under section 41(1). There may be a situation where there is a successor in the business. That means the deduction or allowance was allowed in the hands of the SSE, and now in the interim there is, say, an amalgamation or demerger or succession of business and the recovery is made in the hands of the successor. Then what will happen? Because now the parties are different. So the provision says that deemed profits in such case will be taxable in the hands of the successor. So this is the provision regarding section 41(1). Now we come to the other special provision which deals with sum received after discontinuance of business, and this is covered by section 176, right? So it may so happen that the SSE is carrying on a business, the business is discontinued, and the sum in respect of that business is received after the business is discontinued, and that sum may go untaxed because the business has been discontinued. So section 176 makes a special provision in this respect. It provides that where any business is discontinued in any year, and if any sum is received after the discontinuance of such business, it shall be deemed to be the income of the recipient, even if the SSE who was carrying on the business and the recipient who is receiving the sum are different, it doesn't matter. The sum which is received after the discontinuance of the business will be deemed to be the income of the recipient, and it will be charged to tax in which year? In the year of receipt, right? But if you look at the logic, the sum should be taxable in the hands of recipient only if it was otherwise taxable in the hands of the SSE when the business who was carrying on the business, right? Because if it was received by the SSE, if say the business was continuing and that sum was received, and if that sum was not taxable as per the provisions of the Act, then naturally after the discontinuance of the business, the sum should not be taxed when it is received by the recipient, right? So the provision says that such sum should have been included in the total income of the person who carried on the business had such sum been received before such discontinuance. So if the sum was not taxable in the hands of the SSE, it should not be taxed in the hands of the recipient even. Further, double taxation needs to be avoided. So for example, if the sum was already charged to tax in the hands of the SSE, it should not again be charged to tax in the hands of the recipient upon its received after discontinuance of the business. Say if rupees 10,000 was taxable because there was a sale of goods on credit. So 10,000 was brought to tax, but the business was discontinued and the sum of 10,000 was received from the debtor after the discontinuance of business. It should not be taxed again under section 176 because it was earlier taxed when the business was continuing. So this is the provision of section 176. Now there is a special provision which is made under section 43CA when there is transfer of land or building, and the special provision provides for the determination of full value of consideration in such cases. Let's look at the provision. So this is section 43CA, and it deals with a situation where there is a transfer by the SSE of land or building or both, right? And such land or building should not be a capital asset. It should not be a capital asset. If it is a capital asset, capital gain will arise, and this is something that will be covered under section 50C, which we will deal in the video on capital gain. So what this includes? This includes a land or building which is not a capital asset, meaning it is a stock in trade, because we are dealing with income taxable under the head PGBP. So therefore, if there is transfer of land or building as a stock in trade, then it will be taxable as business income. So section 43CA basically covers the cases of which kind of SSE? An SSE basically which is engaged in the real estate business, right? So in the case of such SSE, if the stock in trade, which is land or building, is transferred, then business income will arise, and business income will be generally computed as what? As the full value of consideration minus the cost, that will be equal to business income. There may be situations where the SSE may try to unreasonably reduce the amount of full value of consideration. Why? Because the business income will also get reduced, and this will lower the tax liability of the SSE, right? So to control this tendency and to prevent such situations and to ensure that the revenue which is due to the government is not suffered, section 43CA provides benchmarking of the stamp duty value of the property, that is land or building, and the consideration. That means the actual consideration. So both are compared, right? Both are compared. If the stamp duty value is greater than 110% of the consideration, then the stamp duty value is treated as the full value of consideration on such transfer. Else, the actual consideration is accepted as the full value of consideration. So if say the amount of consideration on transfer of say land or building is 1000 rupees, okay, and 110% of the consideration is, which is the benchmark, this will be 1100 rupees, right? So now the stamp duty value of the property will be checked. If the stamp duty value is more than 1100, if it is more than 1100, then the stamp duty value will be taken to be the full value of consideration for the purpose of computing business income, right? If the stamp duty value is up to 1100, then the actual consideration of 1000 will be accepted. Actual consideration of 1000 will be accepted. And this is what the provision of section 43CA does. Now the assessee may claim before the assessing officer that look, the stamp duty value, fine, you are taking the stamp duty value because it's greater than 110% of the consideration, but it is even more than the fair market value of the property on the date of transfer. So if a stamp duty value is even more than fair market value, that means there is something wrong. That is clearly unjustified. And that should not be done. In such case, the assessing officer may refer the valuation of the property to whom? To the valuation officer for a proper valuation, right? But here there is a further condition. What is the condition? That the SDV should not be disputed in any appeal or revision, or no reference has been made before any other authority or court by the assessee. Because if that be the case, then whatever is decided by the authority or the court will be considered for the purpose of determining the business income. But if this is not the case, then the assessing officer may refer the valuation of the property to the valuation officer, and then the valuation officer will ascertain the valuation of the property. Okay, now here the assessee is claiming that look, the SDV is even more than FMB. Now the AO will refer the valuation to the valuation officer. Now there will be two situations which may arise. The valuation officer can say that look, the valuation is even more than SDV. So SSE was saying that SDV is more than FMV, but valuation officer comes and says that look, actually the valuation is even more than the SDV. So now should the valuation ascertained by the valuation officer be considered or be treated as the full value of consideration? So here the provision provides for a relaxation and says that no, it's fine. We won't take the valuation determined by the valuation officer. In such case, we will restrict the valuation to the stamp duty value only. So in such case, the full value of consideration will be the stamp duty value. There could be another situation where the valuation officer determines a lower valuation, which is equal to or less than the stamp duty value. In such case, of course, the provision says that the valuation which is ascertained by the valuation officer will be considered for the purpose of section 43CA. So, by default, if the stamp duty value is more than 110% of the consideration, the stamp duty value will be taken. If stamp duty value is up to 110% of the consideration, then actual consideration will be taken. If the SSE claims that the stamp duty value is even more than the FMV, then the AO may, and if he has not disputed the stamp duty value before any authority or court, then the valuation will be referred to the valuation officer. If the valuation officer determines the valuation which is even more than the SDV, then the valuation will be taken as SDV. It will be restricted to that level. But if the valuation ascertained by the valuation officer is up to or less, basically up to stamp duty value equal to or less than SDV, then the valuation ascertained by the valuation officer will be taken. And in terms of 43CA, the full value of consideration that is taken, it will be considered in computing the business income of the SAC in respect of transfer of such land or building. Now 43CA does not apply to any asset other than land or building. Now stamp duty value is taken on the date of registration of the property, because that is considered as the date of transfer. So SDV on the date of transfer is taken for the purpose of 43CA, right? But there is also a date of agreement when the agreement to transfer is entered into, right? So we take SDV on this date, right? Generally under section 43CA, but there will also be a date of agreement, and there could be a situation where both these dates are different. That means date of agreement and date of registration are not the same. And then there will be an SDV as on the date of agreement as well. And both the SDVs on both these dates may differ. In such case, the question will be that whether for the purpose of 43CA, we should take SDV on the date of registration or on the date of agreement. It will be in the interest of SSE to take the SDV which is as low as possible. So if, for instance, the SDV on the date of agreement is lower than the SDV on the date of registration, if say the date of on registration, if say on the date of registration SDB is 1000 rupees, but on the date of agreement it is 900 rupees, right? So the SSE may be inclined to adopt rupees 900 as the SDB. So the question is this option given to the SSE in the first place under section 43CA? So 43CA provides this, yes, this particular option may be allowed to the SSE. So the SDB on the date of the agreement may be taken into account. It is not compulsory. The SSE may take the SDB as on the date of agreement instead of SDB on the date of registration. However, there is a condition. There is a condition which needs to be satisfied. This benefit can be availed only where the consideration or the part thereof, maybe whatever small part of the consideration is, but the consideration, either whole of it or any part thereof, is received by a specified mode, on or before the date of agreement. So either on the date of agreement or any time before the agreement, the consideration or any part thereof should have been received by the SSE by a specified mode. What do we mean by specified modes? The list of specified modes is the same as that we saw when we were discussing the disallowance of payment greater than 10,000 made by non-specified mode to a person in a day. So the list is the same. So if the consideration or a part thereof is received by a specified mode on or before the date of agreement, then this benefit is available to the SSE, in which case the SSE can compare the SDV on the date of agreement and the date of registration, and he can take either the SDV on the date of registration or date of agreement. Obviously, if the SDV on date of agreement is lower, the SSE would like to adopt the SDV on the date of agreement. We will now look at the compliance provisions. And we will look at two important provisions. First, dealing with the maintenance of accounts, and then the tax audit. Maintenance of accounts is covered by section 44AA read with rule 6F. And now let's look at what is the prescription in this regard. Firstly, we need to check if it is a case of a person carrying on a specified profession, or is it a case of a person carrying on a business or a non-specified profession. Now the question is, what is a specified profession? A specified profession is legal or medical or engineering, architectural, accountancy, technical consultancy, interior decoration, authorized representative, film artist, company secretary, and information technology. This is a specified profession. Further, we need to see what is the scope of a film artist. So film artist means any person who is engaged in his professional capacity in the production of a cinematographic film. Whether the film is produced by him directly or by any other person, it doesn't matter. And the professional capacity of what? As an actor, cameraman, director, Wherever there is a star, it includes an assistant director. Okay. So actor, cameraman, director or assistant director, music director or assistant music director, art director or assistant art director, dance director or assistant dance director, an editor, singer, a lyricist, story writer, screenplay writer, dialogue writer, and dress designer. So this is what is meant by a film artist. So if a person is carrying on a specified profession, we then need to check what is the total gross receipts in the profession. Total gross receipts in the profession. And we need to check this figure for all of the 3 immediately preceding previous years. So 1, 2, 3, and 4. So this is previous year 0, which is the current previous year, minus 1, minus 2, minus 3. So preceding 3 previous years. We need to check the total gross receipts in each of these previous years. And if in all the 3 immediately preceding previous years, the total gross receipts is greater than 1.5 lakh, then Rule 6F becomes applicable. And the person should keep and maintain the books of accounts and other documents as prescribed in Rule 6F. We will look at Rule 6F in some time. So this is about specified profession. If this is not the case, that means if total gross receipts is not more than 1.5 lakh in all the 3 immediately preceding years, then in that case, no particular prescription is provided, except that the person should keep and maintain such books of account and other documents as may enable the AO to compute the total income in accordance with the provisions of the Act. In other words, reasonable books of accounts and other documents. So if this condition is satisfied, then Rule 6F prescription applies, else reasonable books of accounts need to be maintained in case of a specified profession. Now we come to a case where the person is carrying on a business, or in case of a profession, he is carrying on a non-specified profession. Non-specified profession. For example, the profession of a teacher. In that case, we need to check the income from business or profession. We also need to check the level of total sales, turnover, or gross receipts, as the case may be in business or profession. And then we need to figure out what is the level of these in any one of 3 immediately preceding previous years. In any one, either this or this or this, in any one of the 3 immediately preceding previous years. So what do we need to check? What is the level? If the income from business or profession is more than 2.5 lakh in any one of 3 immediately preceding previous years, or the total sales, turnover, or gross receipts in the business or profession is more than 25 lakh in any one of 3 immediately preceding previous years. If yes, then reasonable books of account need to be maintained. That means as may enable the AO to compute the total income in accordance with the Act. But if this condition is not satisfied, then there is no prescription and no requirement has been prescribed in respect of maintenance of books of accounts and other documents. Now this limit of 2.5 lakh for income and 25 lakh for total sales, turnover, or gross receipts is with respect to an individual or HUF. For other persons, there is a reduced limit. So 2.5 lakh becomes 1.2 lakh and 25 lakh becomes 10 lakh. Now, what happens in a situation where the business or profession is newly set up? That means the current previous year is the first previous year. So how do we check the levels? So how do we check the levels of the thresholds in the immediately 3 preceding previous years? Because the current previous year is the first previous year. So in that case, it is provided that the monetary limits in this chart, that means 1.5 lakh or 2.5 lakh or 25 lakh, need to be checked. It need to be checked whether these limits are likely to exceed or not during the current previous year, during such previous year. So we need not go beyond, we need not check the immediately 3 preceding previous years, because obviously that will be nil. So we need to check the likelihood of exceeding these particular limits during the current previous year. Now we come to the prescription of Rule 6F. And when is Rule 6F applicable? It is applicable only in the case of a person carrying on specified profession, not in other cases. Even if the person carries on specified profession, it is applicable only when the total gross receipts is greater than 1.5 lakh in all the 3 immediately preceding previous years, only then Rule 6F triggers. And in such case, the books of accounts and other documents need to be kept in accordance with Rule 6F. And Rule 6F prescribes the documents which we will now see. So as far as the general requirement goes, that means for all kinds of specified professions in all the cases, what needs to be maintained? Cash book, journal, if accounts are maintained according to mercantile system of accounting. The assessee needs to maintain a ledger. Then carbon copies of bills and receipts which are issued by the assessee or by the person, but only where the sum is more than rupees 25. The assessee, the person, also needs to maintain what? Maintain original bills and receipts which are issued to such person in respect of expenditure incurred by him. In place of original bills and receipts, payment vouchers can be kept where bills and receipts are not issued and the expenditure incurred is not greater than rupees 50. So this is the general requirement. There is an additional specific requirement for a person carrying on a medical profession. So in addition to the general requirement, such person also needs to keep and maintain a daily case register and medical inventory as on the first and last day of the previous year. And now, as per Rule 6F, these books and documents are to be kept and maintained at the place where the person is carrying on the profession. Where the profession is carried on in more than one places, at the principal place of profession. But if the person is keeping separate books of accounts at each place where the profession is carried on, they may be kept at each such respective place. There is also a time limit for which the books and documents need to be kept and maintained. And that is a period of 6 years from the end of the relevant assessment year. This is the time period for which the assessee needs to keep and maintain the books of accounts. After this period is over, the books and documents may be disposed of by the assessee. So this was the requirement in terms of maintenance of books of accounts and other documents. We now look at the provisions of tax audit. And this is provided in terms of section 44AB read with rule 6G. So section 44AB requires a person carrying on a business or a profession to get his accounts audited and furnish the report of such audit in the prescribed form. And this is commonly called a tax audit, and the report is commonly called the tax audit report or TAR. Now, what is the requirement? We will look in this chart. So we need to see whether the person is carrying on a business or a profession. If the person is carrying on a profession, then we need to check the level of gross receipts in the profession. If these are greater than 50 lakh in the previous year, in the current previous year, if the gross receipts are greater than 50 lakh in the previous year, then tax audit is required for the previous year. Else tax audit is not required for the previous year. So the threshold for a profession is 50 lakh in terms of gross receipts. Now in the case of person carrying on a business, we need to check conditions 1 and condition 2. Condition 1, we need to check the amounts received during the previous year by the person, and we need to aggregate all such amounts, and these include amount received for sales, turnover or gross receipts. So we need to compute all the amounts received by the person during the previous year and aggregate. And the cash mode receipts, amount received in cash mode should not be more than 5% of the said amount. So we determine all the amounts received, we determine the aggregate, and the cash mode component should not exceed 5%. Should not exceed 5%. Similar exercise is what we do in respect of payments. So we determine all the payments made during the previous year, and this includes amount incurred for expenditure. And then the cash mode payments made in cash mode should not exceed 5%. Now, if both the conditions are fulfilled, that means cash mode receipts do not exceed 5% of the aggregate amount of receipts, and the cash mode payments do not exceed 5% of the aggregate of all the payments. In other words, it indicates that the business of the person is running in a very high digital transaction mode. Cash mode transactions are very, very less, both for receipts and payments. In each of the cases, they are less than 5%. Less than 5% of receipts and less than 5% of the payments. In such case, the threshold for tax audit is rupees 10 crore. Else, the threshold for tax audit is only rupees 1 crore. Now this threshold is in respect of what? It is in respect of total sales, turnover or gross receipts as the case may be in business. So if the total sales, turnover or gross receipts as the case may be in business is greater than 10 crore, where the 10 crore threshold applies, then tax audit is required, otherwise tax audit is not required. Where the threshold is 1 crore, then if the total sales, turnover or gross receipts in the business is greater than 1 crore, tax audit is required, else tax audit is not required. Now what is the meaning of cash mode? As we saw above, cash mode receipts should not be more than 5% of the total receipts and cash mode payment should not be more than 5% of total payments. If both these conditions are satisfied, then the threshold of 1 crore is increased to 10 crore. So the question is, what is cash mode? Cash mode means cash or check which is not account payee check or bank draft which is not account payee bank draft. In other words, examples of cash mode transactions are by cash, by uncrossed check, by cross check, which is not account payee, or by a bearer check, right? So this is what is cash mode. So cash mode is what is relevant here in order to determine whether the threshold of tax audit should be 1 crore or 10 crore in the case of a business. In the case of a profession, this criteria of cash mode doesn't apply. There is this uniform criteria of 50 lakh. Further, as against section 44AA books of accounts, the differentiation between a specified profession and non-specified profession is not applicable here. For all kinds of profession, there is a uniform threshold of 50 lakh. So if we see this chart, tax audit is not required if the total sales, turnover or gross receipts is up to 1 crore. It doesn't exceed 1 crore. If it doesn't exceed 1 crore, then the cash mode level is really not relevant. One need not check. Similarly, if the total sales, turnover or gross receipts exceed rupees 10 crore, then in any case, whether the threshold is 1 crore or 10 crore, tax audit will apply. So even then the cash mode level is not relevant. So tax audit is not required in the case of business where the level is up to 1 crore, right? And tax audit is definitely required in a case where the level is greater than 10 crore. And in both these cases, there is no relevance to check what is the level of cash mode. Now you would remember that in the case of section 44AA, books of accounts, the sales, turnover or gross receipts level were supposed to be checked for the immediately preceding 3 previous years. But in case of tax audit, we need to check the respective values, the thresholds for the current previous year. Now, what is the compliance requirement? Once we figure out that tax audit is required, then two things need to be done. One, the person should get his accounts of the previous year audited by an accountant. When? Before the specified date. And further, the person should furnish the tax audit report in the prescribed form by the specified date. Forms 3CA, 3CB and 3CD. So the question is, what is the specified date? So it means the date 1 month prior to what? To the due date for furnishing return of income under section 139(1). So it is either 31st of July or 31st of October or 30th of November. Thus, for example, if the due date to furnish return is 31st of October, the due date to furnish tax audit report will be 1 month prior to this, that is 30th of September. Now, there could be a situation where the person is required to get his accounts audited under any other law, for example, under the company's law. In that case, it is sufficient compliance with section 44AD if such person gets the accounts audited under such law, for example, company law, before the specified date and furnishes the audit report under such law, for example, company law, by that date, plus a further report in form 3CA, a further report in form 3CA. That will be sufficient compliance with the tax audit provisions. And now finally we move to discuss the provisions with regard to the presumptive income for small enterprises. Now, computation of income under the head PGBP involves a detailed working of various allowances, deductions and disallowances, and this can really be cumbersome, especially in the case of small enterprises. And therefore, the idea of these provisions is to ease the compliance burden and facilitate ease of doing business. And therefore, these provisions provide for determination of profits and gains of business or profession on a presumptive basis. That means at a predetermined rate. And therefore, there is no need to make detailed computations under various provisions of this head. Consequently, there would obviously be no need to comply with the provisions of sections 44AA dealing with books of account and 44AB dealing with tax audit. And there are three schemes basically: section 44AD, which governs small businesses, section 44ADA, which governs a small specified profession, and section 44AE, governing the case of an SSE engaged in the goods carriage business. Now we will look at the provisions under each of these schemes, and this tabular presentation ensures that it's easy on you and it also helps you to get a comparative idea across these three schemes. First, we will look at the provisions governing presumptive income for businesses, which is contained in section 44AD. Who is the eligible person? Eligible person is an individual, HUF, or a partnership firm who is a resident, but not a LLP. So you would also note that a company is also not eligible. So who is eligible? Individual, HUF, or partnership firm is eligible. LLP, company, or any other person is not eligible. A non-resident is also not eligible. The eligibility criteria is that the SSE should be engaged in any business, but not under section 44AE. Why? Because 44AE is contained in a different scheme. And the idea is that the business should be a small enterprise. And therefore, the total turnover or gross receipts in the previous year should not be more than rupees 2 crore. An additional eligibility condition is that the SSE should not claim deduction under section 10AA or chapter VIAC. 10AA, tax deduction for newly established units in SEZ. We have discussed this in the video on exempt incomes. Chapter VIAC, deduction from gross total income under section 80HS to 80 RRB. So either you claim 10AA or VIAC, or you claim the benefit of presumptive income provisions. You cannot claim both. Now chapter VIAC deduction is barred. This means that chapter VIAB deduction, that is 80C to 80 GGC, is not barred. Chapter VIACA deductions are not barred, 80 TTA and 80 TTB. And chapter VIAD deduction is not barred, 80U. What is barred is chapter VIAC deduction and 10AA deduction. A further condition is that the person should not fall under 1 or 2 or 3. So section 44AD does not apply to a person who is carrying on a specified profession under section 44AA. 44AA, books of accounts, and we saw in that provision what is the scope of a specified profession. And why this exclusion? Because 44ADA may apply in such case, which we will discuss. So 44ADA is the presumptive scheme in respect of a profession. Second, section 44AD does not apply to a person earning income in the nature of commission or brokerage or carrying on any agency business, because the margins in such businesses are really high, and mostly the actual business income would be much higher than the presumptive income, and therefore these kinds of businesses have been excluded. Now, if these conditions are satisfied, then deemed profits and gains are computed under section 44AD on presumptive basis or at a predetermined rate. So deemed profit and gains taxable under the head PGBP is equal to the following. For that, we need to figure out the amount of turnover or the gross receipts, for the previous year. And then we need to bifurcate this into two parts. We need to bifurcate this into two parts. A, turnover or gross receipts on account of such business which is received by a specified mode. What is the specified mode? We have already discussed this in various provisions in this video, right? Specified mode. So turnover or gross receipt in the previous year on account of such business which is received by a specified mode or before the due date of furnishing return under section 139(1) of that previous year. So turnover or gross receipts in the previous year which is received by a specified mode not only during that previous year but also extending till the date of till the due date for furnishing return for that previous year. So across this period, whatever be the turnover or gross receipts received by specified mode, that is A. And we compute 6% of that. We compute 6% of that. On the balance of the turnover or gross receipts of that previous year on account of such business, we compute 8% of that. And then we add both, and that gives us the amount of deemed profits and gains, which is taxable under the head PGBP. Now, since the business income is computed on a presumptive basis, the various specific deductions allowable under sections 30 to 38, which we have discussed in this video, are deemed to have been already given full effect to. They are deemed to have been allowed, and therefore no further specific deduction under those sections is allowed. The business income is computed at the specified predetermined rates. So this means depreciation is also deemed to have been allowed and it is not separately allowed. But then the question is, we need to keep computing the written down value of the assets year on year. So how do we do that? Written down value of any asset of the eligible business or profession, eligible business in case of 44AD, is deemed to have been calculated. We calculate it as if the depreciation had been claimed and had been actually allowed. So we just keep on we keep accounting for the depreciation, and accordingly we keep computing the WDV of the assets of the relevant business. Now, can the SSE claim a sum which is higher than the presumptive income computed under section 44AD? Yes, the SSE can claim to have earned a higher sum, a higher income than the presumptive income computed under section 44AD. And as we noted in the introductory part, where the SSE declares profits and gains under these provisions, he is not required to comply with 44AA books of accounts or 44AB tax audit. There is no need. So he's not required to comply. Now the question is, can the SSE claim a lower income than the presumptive income? Lower income than the presumptive income. Now when we talk about section 44AD, there is a lock-in period of 6 years. There is a lock-in period of 6 years. What does this mean? If the SSE declares profits for any previous year under section 44AD, then he should continue to do so for the next 5 previous years as well. So that means the year in which he starts declaring, year 1 plus next 5 previous years, that means 6 years. So 6 years becomes the lock-in period. If there is a default, that means if he declares profits for any of such 5 previous years, right? Because in the first previous year, he has already opted under section 44AD. And within the next 5 previous years, if within those 5 previous years he opts out, why would he do so? Because he may claim a lower income than that computed on presumptive basis under section 44AD. So he opts out before the end of this lock-in period. Then he shall not be eligible. So obviously in the year in which he opts out, he will not be governed by 44AD, but also he will not be eligible to claim the benefit of 44AD for 5 previous years subsequent to the previous year of opting out. So the previous year in which he opts out plus 5 subsequent previous years. That means he will be out of 44AD for 6 previous years. So effectively there needs to be a lock-in of 6 years. Now in such case, if he is made to move out of 44AD benefit for 5 subsequent previous years, then the following implications will arise for those previous years. he will need to comply with section 44AA. That means he will need to keep and maintain books of accounts and other documents. And he will need to comply with 44AB as well. That means he will need to get tax audit done and furnish tax audit report. But he will need to do this only where his total income, not the business income, but the total income is more than the basic exemption limit. If, however, his total income is not more than the basic exemption limit, then the 44AA and 44AB requirement will not apply for those 5 subsequent previous years for which he is made to move out of section 44AD. So this is the implication. So if the assessee is okay with this implication, he can claim a lower income than the 44AD presumptive income and then opt out. Now we turn to the provisions of section 44ADA. So 44AD governs a business, 44ADA governs a profession. Who is the eligible person? An individual or a partnership firm who is a resident but not a LLP. So LLP is out. So it is similar to 44AD. But the difference is that in 44AD, an HUF can take the benefit of 44AD, but HUF is out of 44ADA. So 44ADA is individual, a partnership firm, but not an LLP, and the person should be a resident. Now the assessee should be engaged in a profession, but in a specified profession referred under section 44AA. We have discussed this under 44AA. So a non-specified profession is not covered. It is not covered under 44AD. It is also not covered under 44ADA. So presumptive scheme doesn't apply to a non-specified profession. And the idea is that it should be a small enterprise. So the total gross receipts in the previous year should not be more than 50 lakh. If this condition is satisfied, and there is no further additional condition to be satisfied, then the deemed profits and gains of such profession taxable under the head PGBP is equal to 50% of total gross receipts in the previous year on account of such profession. So 44AD, we had the rates of 6% of turnover or gross receipts or 8%, as the case may be, or 6% for a part of turnover or gross receipts or 8% for a part, and then we aggregate. But for 44AD, it is a straight 50% flat of total gross receipts on account of such profession. So this becomes the presumptive income. Just like 44AD, in 44ADA also, specific deductions under section 30 to 38 are deemed to have been allowed, so no specific further deduction is allowed. What about computing written down value of the assets? Similar provision applies as we discussed for 44AD. Can the assessee claim a sum higher than the presumptive income? Yes, same as 44AD. Books of accounts provision and tax audit provision 44AA and 44AB doesn't apply, same as 44AD. Now, can the assessee claim a lower income lower than the presumptive income under 44ADA? Now in 44AD, we saw that there is a lock-in of 6 years and there are implications of opting out, that the assessee is forced to move out of 44AD for subsequent 5 previous years as well. But this restrictive provision is not applicable to 44ADA. The assessee can claim in any previous year that his profits and gains, the actual profits and gains are actually lower than the presumptive income, and then claim the lower income as compared to 44ADA. So this can be done in any previous year. There is no concept of a lock-in. But in such case, similar implication arise which were there for 44AD. That means where the total income is more than the basic exemption limit, the assessee needs to comply with 44AA and 44AB. But even this need not be done where total income is less than the basic exemption limit. We now look at the scheme of section 44AE, which also applies to a business. But while 44AD applies generally to a business, 44AE applies only to a specific business of goods carriage. Now 44AE is eligible in the case of all persons, as against 44AD and 44ADA where there is a restriction. 44AE applies to all persons are eligible. And the condition is that the assessee should be engaged in the business of plying, hiring or leasing goods carriage. So he should be engaged in the goods carriage business. And the idea being that the enterprise should be a small enterprise. The condition is that the assessee should not own, ownership is important, should not own more than 10 goods carriages at any time during the previous year. At any time during the previous year, we need to check that the assessee should not be owning more than 10 goods carriages. If this condition is not satisfied, then 44AE benefit cannot be taken. There is no further condition. Now, once this condition is satisfied, then deemed profits and gains of such business taxable under the head PGBP is supposed to be calculated as per the formula as you can see on the screen. And we make this computation for each goods carriage which is owned by the assessee in the previous year. Now we need to figure out whether the goods carriage is a heavy goods vehicle or other vehicle. So the question is, what is the meaning of heavy goods vehicle? Heavy goods vehicle means any goods carriage whose gross vehicle weight is more than 12,000 kg or 12 ton. Gross vehicle weight should be more than 12,000 kg or 12 ton. That is called a heavy goods vehicle. So in the case of heavy goods vehicle, how do we compute? It is rupees 1,000 multiplied by the gross vehicle weight or unladen weight as the case may be in ton, multiplied by months or part of a month during which the vehicle is owned by the assessee in the previous year. For example, if the assessee acquires or purchases a heavy goods vehicle on say 15th January of the previous year, so the presumptive income will be rupees 1,000 into gross vehicle weight or unladen weight as the case may be in ton. So for example, if the gross vehicle weight is 15 ton, so it will be 1000 into 15 into months or part of a month of ownership. So from 15 Jan to 31st March, January part of a month, February, March 3. So this will be 40, 15 into 3, 45, 45,000 will be the 44AE presumptive income in respect of that heavy goods vehicle. Okay. If say the vehicle is not a heavy goods vehicle, then the rate is rupees 7,500 multiplied by months or part of a month of ownership during the previous year. So if say in this case the vehicle is not a heavy goods vehicle, so the 44AE presumptive income will be what? It will be 7,500 into 3. That means months or part of a month from 15th of January. So this will be the 44AE presumptive income for that vehicle. So we need to make this calculation for each vehicle and then we aggregate that up and that becomes the 44AE presumptive income for the assessee for that previous year. Now similar to 44AD and 44ADA, the specific deductions are deemed to have been given full effect to and therefore no further specific deduction is allowed. But there is a difference. In the case of 44AE, where the assessee is the firm and there is salary and interest which has been paid to its partners, it is further allowed as a deduction from income computed under section 44AE, subject to 44B limit, which we have discussed earlier in this video. So salary and interest is further allowed as a deduction from 44AE income, but this is not allowed under section 44AD and 44ADA, and this is the difference. Computation of written down value of the asset, same as 44AD and 44ADA. Can the assessee claim a higher income? Yes, a higher income can be claimed to have been earned by the assessee for each vehicle. Whether 44AA and 44AB need to be complied? No. Similar provision as 44AD and 44ADA. The assessee is not required to comply with the provisions of 44AA or 44AB. Can the assessee claim a lower income than that computed under 44AE? Yes, the assessee may claim lower profits and gains than that computed under section 44AE in any previous year. So there is no lock-in period of 6 years like 44AD. But the condition is that the assessee should comply with 44AA and 44AB, and in that case he can claim a lower profits and gains as compared to 44AE. And therefore this particular relaxation, that 44AA and 44AD need not be complied with where total income is not more than basic exemption limit. This relaxation which applies for 44AD and 44ADA doesn't apply to 44 AE. So for 44 AE, if the assessee wants to claim a lower income, then 44 AA and 44 AB need to be complied with. Now for computing 44 AE income, what we noted is that the period of ownership of goods carriage is relevant, because in the formula for computing presumptive income, the rate needs to be multiplied by month or part of a month during which the vehicle is owned. So this also means that put to use condition is not relevant. If the vehicle is not put to use, or the date when it is put to use, it is not relevant, the computation of presumptive income is made as per the formula. So this brings us to the end of the discussion on provisions regarding presumptive income, and this also brings us to the end of this video on computing income under the head profits and gains of business or profession. Hope the various provisions are absolutely clear to you, but in case there is any doubt or you need any clarification, feel free to approach me, contact me, or write to me. Do write your comments in the comment box, and do like this video and share it with your friends and colleagues for their use and benefit. So all the best to you. A very good day to all of you.